material I have had posted in the materials section so that you can see where I'm taking this from. This is from 2009, a presentation made at our conference on the single audit quality study. Of course, you know, you're still seeing A133. So this is quite old, 2009. That's 11 years ago. And I think I had not quite the color hair I have now. It's gotten grayer. I'm not sure if it's because of this single audit stuff or not. But I want to start this conversation off with perspective. There are a lot of people now who are probably on this webinar today who don't have the context of why things are the way they are. So the older you may be, or certainly more experienced you may be, if you've been here over 10 years working in this area, this will just simply be a little reminder of a simpler time, I guess. It was kind of a similar era. You know, we were just dealing with the huge crisis that was, you know, the financial meltdown, a lot of lender problems, housing market cratering, the stock market cratering. And now we're in the COVID area, and just a lot of uncertainty and unusual things going on. And the bailouts are similar from the perspective that ARA, and we don't need to worry about, we won't be talking about anything about ARA except this, which is to say they put out a lot of money and figured out the rules as we went. And that's exactly where we are with the CARES Act. We dumped about $2 trillion into the market with no planning, no guidance, no rules. And just today, I was on the phone with HUD, the REACT people in particular, about some of the financial reporting issues related to the CARES Act. And they are not totally cognizant, I guess, of the requirements. And that kind of puts me back into context again of this presentation here. Now, this presentation was presented by George Datto, who was a HUD OIG at the time, kind of a curmudgeonly guy. If you were listening to him in conference, he could be interesting. I actually really enjoyed him. We were good friends. A much different person in private than maybe he was at the presentation as he was reading the hard line. But if you look at what this really amounted to, this National Single Audit Sampling Project, and this hasn't happened again. It's supposed to happen soon. I mean, if you're looking at the Q&A on the single audit, you know, the OMB website, they're mentioning doing this again in 20. Obviously, there's no way in Hades they're ever going to do this, but it's still pending some funding. And what they did was they just had this inkling. In fact, if you go back all the way, you'll see there are two competing conversations happening here at the same time. Well, they're not competing. They're just happening at the same time. One is with DOL and dealing with the pension, you know, OPEB audits essentially, or, you know, the pension plans. And the other would be single audit. Now we're here to talk about single audit today. And you can see that the summary here of how this worked out was deemed to be problematic. So we said about 48% of these could be accepted. Some, certainly a big portion of those acceptables were with deficiencies. And then 16% had significant deficiencies and were deemed to be of limited reliability. And then, of course, 35 of these things, percent-wise, were determined to be unreliable or unacceptable to the point of, hey, you guys, you know, don't know what you're doing. Now, frankly, here's the problem. Most of this, especially for multifamily, does not ring true. And by the way, this class is going to be single audit with a focus on multifamily. This will not be really twisting this stuff back to public housing. And for that, I guess I probably need to apologize for not making that clear, although the principles would be the same. This conversation will lead us much more in a multifamily direction and be focused in that particular set of programs. Well, the problem with some of these things, as you look at them, and I will just go to the next slide, and like I said, this should have been in the materials, is misreporting the audit coverage of major federal programs. And then you had unreported findings, which is fine. And then we get to a third one, which is listed as a thing saying, hey, this is most frequent. Compliance testing not documented as performed or not applicable. Ooh, okay. And then they went down to deficiencies in understanding and testing of internal control. That continues to this day to be a significant conversation. And this year in the compliance supplement, part 6 has been revised to attempt to make this process a little better for us inside the compliance supplement itself. So that's an interesting way to look at those, and those were deemed to be most frequent. Now let's just talk about the planning, how this goes, or deficiencies in risk assessments as part of a major program thing. We didn't get listed there as a most frequent, but the problems that were there were highly major or multifamily related. And we'll talk about why that is here in a minute. And it really means nothing to me. It means nothing in terms of the outcome of the audit. So this stuff is all listed as big problems when in reality, the audits were being done correctly. And you'll see as we walk through the uniform guidance requirements, I'll point out, where this really, or how this occurred and why it wasn't really a big deal, but it's considered a big deal. And that sounds kind of confusing. But how did HUD fare in the sample? Well, not too great. They broke these things into stratums. One stratum was the larger clients, and of course the next stratum was smaller. I mean, that's easy to see that going on. And when you look at HUD is the lowest of the reliable categories. And some of that is public housing, okay? But some of that is multifamily housing, and the statistics are skewed as a result. When you look at the total number of unacceptable audits, HUD is huge. Okay, now HHS is worse in the stratum 2, but has a percentage of, scope. In HHS, you're 78% likely to be good, 11% bad. But when you get to the smaller stratums, 45% are still acceptable and 41% aren't unacceptable. That points us in the direction of smaller entities, both for HHS and HUD. And HUD really fares the worst out of all this. Now, HHS did a lot better on the bigger clients, but the smaller projects or people that were running the programs, that the intention being, I guess, or not the intention, the conclusion is that the smaller projects have bigger problems. And why is that? And some of these were audited. The distinguishing things were even who audited this who brought this conversation up. Well, anyway, at the end of all this conversation, you get this approach that says, we need to fix this. Now, unfortunately, we start to fix things that truly are not broken. And we'll see some of that as we move on. And some of that related or resulted in uniform guidance. The other thing that happened that interests us today is that this also had engendered a change in the audit guide for the for-profit side. George knew this, knew all this stuff takes, risky audits. I mean, it's kind of a crazy thing to say it that way, would be the employee benefit plans and a single audit. And by nature, HUD drags around or HUD for-profit gets drug into that thing kind of behind single audit. But those would be big changes. And of course, coming up with new compliance auditing guidance, which was uniform guidance. And so the SASs, now this talks about AUC 935. The first bullet here would be the new compliance SAS. That's AUC 935, which is just undergone or is undergoing a revision as we speak. I mean, it's going to be implemented next year after COVID kind of fades away. And then coming up with a couple of other things about how to report findings and documentation. And this is where we get onto the documentation process that continues on to this day, which is if you didn't write it down, it didn't happen. And further, there are planning procedures that if you didn't write it down, it didn't happen. Okay. And then, of course, you get the process anyway coming out. Now, if you walk all the way down to the deficiencies, and this, I don't have he didn't number his slides, so this would be down onto what is essentially slide 17. Required risk analyses were not documented at all, and the basis for the assessment of risk was not documented. Now, this is single audit, so we're talking about the A/B risk assessment process and how we failed. Now, the truth is we did not fail, most of us. There are failures. There are always failures. But for the most part, these failures are related to programs where they had a major loan program has the sole single audit program. And they did not document the A/B risk assessment model because there's only one program. You know what you're going to test because it's the only program and it's a loan. And if you don't fill out the A/B risk assessment for that, you are a failure. That's the kind of things that happened in this study. Okay. And so they're saying the documentation indicated that the risk assessment was not performed or not properly performed for a lot of reasons, but most of those reasons in multifamily involve only one or two programs. One very large loan program and one somewhat significantly less material subsidy program. Well, you can do that in your head. You know what the major program is. And that's the kind of thing that gets really wrung out that nobody pays attention to in this particular case for single audit. And that's kind of drive our discussion about how we make this better as we move on. So we gave up some specific guidance, revised that, and then major program level. The auditor, this is just giving you the context. In 10.4% of the Stratum 1 audits reviewed and 20 of the Stratum 2 audits reviewed, the auditor did not document whether he or she considered materiality at the major program level. Okay, well, I hope we're not making those mistakes still. But if you walk through the rest of these slides, and I'm not going to go through any more of this, we could get to internal control, which hasn't changed that much. And then we get to the AICPA. Now you already know what's going on or why the AICPA behaves in the way it does with peer review. And let me just tell you the basic risk. The government said to the AICPA, if you can't get your stuff together and handle these peer reviews correctly, we will come in and remove peer review on these audits from the AICPA, and we will begin doing peer reviews ourselves, which was the ultimate, can't face that. Nobody could face that outcome. So we ratchet up, turn the screws down on it, ratchet up the compliance monitoring, and start pounding everybody into smithereens. It's like a battering ram. And we've done more now to address these issues than we could have ever essentially imagined. And that's why we're here today, or what my focus will be today. At least now you understand why I will bring up the things I discuss. Now, single audit in general, I'm going to do a couple of things in this slide deck. I have people who really aren't single audit people, and some people who are single, who are really single audit folks looking for an update. So we're going to span that gap in multiple areas. And I hope it's not too trudging through the weeds, but I thought we would start off with just a little bit of information on 2 CFR 200 anyway. Background information. You know that we had previously implemented A133, and we had all the circulars. And we came up with what was called the super circular at the time, or God, there was another nickname for it. I don't remember what we would have called it, but what's just really come into being is UG now. And you took all those cost circulars, administrative requirements, and the audit requirements, and you blended it into one place. And that one place is now the single audit act was implemented through this circular. Now, a good share of the circular itself, or the or uniform guidance, really is oriented towards the client's behavior. And we've put that all, if you're looking at cost circulars, that's really essentially part 4 or subpart D of the compliance supplement, or E maybe. Gosh, I forget these E's and F's. But anyway, F would be the audit requirements, the one thing we never lose sight of. And there's reasons for this to be interesting. Let me just say this, that in terms of most of the other circulars that mattered to us, like A87 or A122, governmental and nonprofit, okay, cost things. Most of those circulars, those older circulars, and those sections of uniform guidance really do not have too much impact on multifamily housing. Now, let's explain maybe why I see it that way. There are requirements, and I don't disagree that they are requirements, but when you look at the nature of the programs we're dealing with, for the instance, we have a large loan guarantee program. That loan guarantee program has never expended essentially a true dollar of federal awards. Yes, we do consider it awards because it's a loan guarantee with ongoing compliance requirements, but we don't really have a federal award we're expending and charging costs to. We built a building or whatever, or refinanced a building with a HUD loan. So those other circulars would not really have a tremendous impact on us. We have a subsidy contract. But again, the subsidy contract has been deemed to be essentially an exchange transaction accounted for under that GAAP methodology, not because we're charging the expenses to the federal awards, but because the federal government is paying the rent for Les Sparks, or Kathy Christensen, or Michelle Pierce, or anyone on this, well, obviously, anyone particularly identified. So we're, again, not really, our costs aren't being charged to a federal award. The federal award is being granted to us at the tenant level. They're paying the rent for John Smith or Michael Jones, whatever. And that's a big difference from the rest of the population dealing with single audit. Public housing, for instance, yes, you build a building and you are having costs that are charged to the federal award. But in multifamily, those awards and all that charging that goes on to put under the P&L of the project really aren't being charged directly to federal awards. That's a big difference in multifamily auditing. So the audit requirements obviously remain, no big problem understanding that, but some of these other things don't really impact us. Now, this has been in place now for 5 years. And I've left some things in here about the grants that were, in here before, just to show you how the transition was going and how people were trying to parse these things out. Frankly, half the mortgages were incurred before the implementation of uniform guidance. But nobody's still going back to audit that under A133. There's no basic reason to go there. So when the award, this was all kind of highlighting when the award was made. Now, sometimes we have 20-year HAP contracts, but they're renewed every year anyway. So HAP became that other, they became federal awards the very next year as things were updated. But loans, obviously could have been older. And even by now, I would guess even 60 to 70% of those mortgages have been refinanced in the last 7 years, 6 to 7 years. So a lot of these are probably coming under uniform guidance. I think the average prepayment speed on a mortgage is just near 6.5 to 8 years. Okay, so that's about how long a multifamily mortgage on average lasts. So we'll probably get out of all those, no more discussions. But one of the other things that changed in this was the addition of a conversation related to COSO. Now, this was a new thing. Obviously, the client was always under the requirement to maintain internal control or to have its, adequate internal control over compliance. Section 303 put into here that they should be sort of in conformance with COSO Green Book. Now, for multifamily day, this would be COSO, and for the government side, more PHA would be the Green Book. But in my assessment, these two things are so undifferent. People do say, "Oh, that's Green Book or that's COSO." No, Green Book is just COSO with a few words changed in it, to make it a little more stylistically appropriate to the government side. But we had to then continue with this, and the client, this requirement in 303 was sort of a must thing. So the client really had to have better things, and they were also told that they were now focused on the personally identifiable information. So this is really one of the first statements that has come out on PII. Now you see HUD doing it on their current notice, 2020-4, and the communication of all this tenant data. That kind of that effect is driving how all this works, and the client is supposed to come up with that internal control. Now, clearly, on a yellow book basis, we reference COSO again, but we're not under GAS required to go there, and we are not required to audit COSO under the client activities. And Kathy, I'll get back to your question in just a second, okay? And that I have a very clear answer for that. When you look at the internal control requirements, here's what the auditors know. You have to test or to assess internal control over compliance at low. And we'll discuss each of these a little more in depth as we get into the audit, subpart F areas. But the client was supposed to have a system that fit this model and worked back into the COSO framework. And that brought us into the principles you would see here, and ultimately down to the other task-related items. Now, one of the biggest things in auditing for me in HUD is changing my attitude from focusing on control activities to focusing on more control environment or risk assessment or monitoring controls. In other words, what you have heard from me in some of these other classes is that the big risk is we get too focused on control activities and not on some of the other environmental governance items that function as controls. And as we assess risk at the financial statement level, we're being told, hey, you don't really do a good job. You're not linking the risks, the audit procedures to the risks. So the missing linkage, right? There's no hairy beast sitting somewhere in between a beast and man, kind of a meast, I guess we could call it. That is the missing link. Yes, I do have a template on Excel, and I'm going to bring that up in just a second, Arthur. Hang on. So when we do this, what we looked at to look at the effect on the audit was to determine that each of the 5 components and 17 principles were present and functioning, and the evidence that the components and the attributes, the many, many more attributes, were brought in together. And of course, we redefined the reporting process. So a material weakness, people don't really pay attention to this, but a material weakness in internal control means that a specific component, principle, or attribute is not present or not functioning. Now, I'm not trying to highlight all the attributes here, although we can do that in another place. But if you're looking at the components, one of those would be missing, or something in the 17 principles would be missing. And even at this level, a attribute is not working that should be there. Okay, there are attributes that don't always apply, but they are not present and functioning. A significant deficiency is where you have a shortcoming in a principle or attribute. So you can't be missing a component. It is a shortcoming in principle or attribute. And so this is something we don't really pay attention to. And that's important, because if you're looking at the compliance model, okay, what they're going to tell you is we've removed, well, I keep talking about we removed. The change from A133 into uniform guidance was focusing less on significant deficiencies and more focus on material weaknesses, which tells you that clearly the issues were bigger because they were required components, principles, or attributes that just weren't, that were supposed to be there and weren't. Whereas a significant deficiency is not a matter of materiality in terms of the impact or the actual finding or thing that occurred. It's more of a decision where the principle or the attribute was there but just wasn't working as well as it should. And that's an interesting perspective to get out of uniform guidance, okay? Now, and I'm going to come to that spreadsheet here in just a minute, but when you look at control activities, they summarized it down here, top level reviews. Now that would be sort of like management reviews the financial statements on a periodic basis. In all multifamily housing, if there is not a management review every month or quarterly on the financial statements, then something is wrong, and it's a key control, and it covers almost everything. So reviews by management at the activity level, or human, what I like the idea of human capital. So an HR function that's managing the people, or how things get executed, right? Now we're getting down into the other things of things. We're getting into the areas where we would normally be focusing. And then, of course, physical control over assets. In our case, that's a big deal for HUD because the regulatory agreement is attaching a security interest to all assets that belong to the project. Now, at various levels, we were trying to get to things that affect multiple components. So where could I find controls that would creep across all of those areas? Well, as far as uniform guidance is concerned, we have tools for that. In fact, I have several. And I didn't bring this over here initially. That was kind of silly. I don't know what my brain was trying to consider at that time. Now, this is the most recent one, and I'll move it over into the area. Now, this is basically just the PPC model reorganized. And if you look at the COSO side, I'll hurry and save this to your area, the shared folders area. I think this is supposed to come over automatically. I'll just put the COSO moniker on it so you know. Now, a lot of these controls, and I know this is probably going to get small here in a minute. You can see that a lot of these are environmental or risk assessment. My whole position on multifamily housing and looking at, say, the HUD Audit Guide in particular, which is not going to go away. For a lot of you, HUD Audit Guide is going to come right back at the end of this, at the second half of this conversation. Governance is appropriate. Code of conduct is in place. And you can see how these controls work out over the span of the components and the principles. Now, I've not listed each principle here, but when you look at some controls, now in this particular case, it's going to be hard to find controls that span the most number of things. Obviously under this area that I'm just trying to show you how they break down. You don't need every one of these, but you need to make sure that enough controls are in place to ensure that the principal and the component are covered by something. Now you can move over to the control activity list, and it will break it down along the lines of the HUD sections, the PPC sections for HUD areas. And it gives you the assertions and the activities. And all we're trying to do is say, look, we can find enough controls to make all this work. And many of the controls, remember, are not activities. They're environmental things or risk assessment things that happen at a owner or governance level. And that is in fact, I can tell you straight away, and I'll do this later with the HUD Audit Guide. The HUD Audit Guide has a good share of these types of controls in it. It's better than, say, the compliance supplement. Now, the supplement has some things in it for the 202 or 811, but the HUD Audit Guide is the best place to find a lot of these HUD imposed controls. And so that template is there and available, and it's exactly why we would, we think we can meet most of those requirements in uniform guidance to get over the hump. So that is there. I'll answer that live. Or maybe Michelle was answering it there. Thank you, Michelle. Now, moving on to uniform guidance again. Procurement. Now, because I might have people that are doing both public housing and multifamily housing, and I don't know. I'm going to go ahead and go through a few of these guidance issues anyway, but let me just say this. As far as multifamily housing is concerned, I do not believe any of these procurement requirements actually apply to the normal mortgage or Section 8 areas we deal with. Now, they may apply to other programs you pick up along the way from other areas. They clearly might. And and even some HUD programs would require that. But a typical 223F mortgage with a Section 8 contract, probably not getting my attention on uniform guidance procurement. And I'll clarify why that is as we go through here. But these are things that are important for the client to execute. There are plenty of uniform guidance requirements, okay? It's just that I'm focusing on multifamily housing more than I am anywhere else. So that is done. But general procurement, everybody has to have some procurement requirements listed. Now, in multifamily housing, we believe the majority of these come from either your Handbook 4350.1 or they come from the Handbook on Management Agents 4381.5. There is no other guidance other than uniform guidance. Okay, so as the nonprofit is picking up a project or two along the way, yes, they are subject to the requirements of uniform guidance, at least in theory. So they have to establish some standards of conduct over conflicts of interest. That should be there. Of course, the general idea is to award to qualified contractors and may use a time and materials contract only after we've determined there are no other way. And we must set a ceiling amount. Okay, so those are just the general ideas. Okay, Stefan, if we have a cap advance 202 from before 14, yeah, but it doesn't really matter if it was modified or before. Procurement is an active requirement. It is marked yes. Can we ignore the procurement requirements of Part 3.2 and rather test Part 3.1 rules? I'll tell you this, Stefan, I would, if you're going into the current compliance supplements, like 20, and we're going to go there in a minute, I don't think it matters one way or another which way you're going to go. I'm probably going to try to talk you out of any of that in this conversation. Now, please understand, I'm going to give you a reason, okay? And I'll explain it, and then you'll have to decide whether you can agree with that or not. But we'll get to that. It's just about 3 slides away. So hang on. And that's my fault probably for saying things like, I don't think this is going to generally apply to multifamily housing. And even on a 202, we'll talk about the compliance supplement for that in just a minute. Okay, so the next thing that's important is competition. And they tell us, you have some things you need to do. The other side of this would be, keeping track of the IOIs, what HUD calls, the related party entities, so that if a management company is really acquiring these services, and that management company may be owned by a nonprofit, that then we really have to be careful about unfair competition and whether or not the actual compliance procurement rules apply in terms of some of these other things coming up. This would not go away even under the HUD handbooks. So unfair competition would be there, and we would still be required to have written procedures on how the procurement occurs. So despite my feelings coming up about how often this doesn't really matter, there are some things that still matter. So a policy, conflict of interests, an actual procurement policy written down, and then making sure people follow those procedures is still a big deal under any UG audit. Now, procurement methods for the micro side. A lot of multifamily housing can be purchased in a micro environment where the only sort of, I was going to say the requirement, the only other attribute of that purchasing that would really follow through there would be the lack or the maintaining of competition. So don't give it always to the same people. You must still show, you can go micro and purchase things, but you still have to show that you're spreading it around a little bit, right? Spread the wealth. And then, of course, it still has to be good work, qualified suppliers. And the micro threshold's up a lot for UG right now. So if you're looking at the thresholds, they're almost all doubled or tripled of what they were prior to COVID. And I think the last time I looked this up, it was $20,000 for micro purchasing. Okay. Now, how this correlates to HUD, and I probably should have typed it in this slide. In fact, I'm going to add it right now, and you could probably just write it in. I'm just going to write it in here as a little note. Okay. Man, I cannot type. Okay, I'm going to put that back on the screen. I probably should have put that in italics or something like that. HUD limit in the handbooks is usually around $10,000. So that's what HUD would say here going into this, is that they're going to say, hey, you should probably start looking at this. So despite whatever else uniform guidance has, HUD's handbooks are going to say, look, you should be looking at this at a $10,000 level. And that's the threshold for both purchasing under reserve for replacements and under the management agent handbook. They're both about they're both $10,000. Now, small purchases, that threshold is currently up to $750,000, which is a relatively simple and informal thing. Use price quotes, you know, from a number of sources. You call them up and ask them. That's how simple some of this can be done right now during the COVID crisis. That was what, 250 before. Originally, it came out at 100. So no state has those. No PHA would ever be able to utilize those limits because governments at the state level are almost half of these usually. But as a nonprofit, you can adopt whatever you need to have. But currently, uniform guidance allows that all the way up to here. And then, of course, you could go down to sealed bids. The biggest place where this normally happens in most UG work would be auditors. I don't know if they're actually sealed, but you know, you're going out for competitive proposals. So there are requirements around the sealed bid area. And of course, we would be more purchasing under competitive proposals, more than one bidder, usually fixed cost or cost reimbursement. Sealed bids aren't really appropriate. There's an adequate number of sources, you know, most advantageous proposal. Now you can go to non-competitive proposals or single source when one or more of the following apply, and that's emergencies. Solicitation from other methods is determined to be inadequate. I've seen this happen a lot with public housing for other certain boutique purchases. There aren't that many people providing the service, but in multifamily, it shouldn't really ever be a problem. Now let's talk about multifamily and my Q&A issue, which has somehow disappeared. I don't know where that went. Okay. Now, oh, there's another question here when I open this up. If the client's written policy threshold for micro purchases is lower than UG, they will always be lower than UG. Then there's no problem with that. You can go as low as you want. You just can't go above. Now, what that really means to me is that you are left with a requirement that is a little thin on most of this area. I mean, it's just making it hard. It's too many things to track, but that's their choice. Now, if we move over to slide 20, and I need to, be moving on past this purchasing stuff here a little bit. I get down into the COFAR, the FAQ. And, if I'm looking at 320, and I'll bring the actual FAQ up here, and I've got it open. I just need to drag my stuff over to it. This slide comes from here. Now, you may think this is a bit of a stretch, but here's where I get out of this at. Do the procurement requirements apply for procurements on indirect costs? For example, would a non-federal entity need to follow them when hiring a plumber to fix a broken pipe in headquarters building? And it says no. Okay, the Uniform Guidance procurement standards do not apply to procurements made in indirect cost areas. Now, we're not really in an indirect cost area per se, okay? But the next sentence is the thing that's important. They apply to procurements for goods and services that are directly charged to a federal award. Oh, interesting comment. I'm charging directly to a federal award. So I added here, generally not applicable to multifamily housing unless I'm using it in construction. Okay, let's go back to multifamily housing. You have a mortgage. That building might not have even been built with that mortgage, but HUD is allowing you to refinance it with a HUD insured mortgage. Are the expenses to run the building being charged to a federal award? The answer is no. And in fact, they're being ran by the management company, even though they're not really indirect costs. The management fee would be an indirect cost. That's how the overhead would be accumulated. But are we charging anything to the 221 D4 or the 223F program? No, the mortgage is just sitting there. It's not increasing, decreasing, anything. It's just sitting there. And we're not really charging to an award in the direct sense. Now, obviously for most multifamily housing, there is no compliance supplement. So let's look at a compliance supplement for 202. And I have it open here, but wouldn't you know, I've got 15 things open in there and cannot read that. But if I open it, hang on. I'm going to open the 2019 one because I have it right here. Easy. I had to anticipate getting here this fast. Okay. And this, Stephanus, where you're asking in particular. Okay. Now I get over here and I see a procurement suspension and debarment marked with a yes. And that would certainly apply or imply that this applies to a Section 202 program. You can't deny that, right? I mean, that's hard to deny. But this program is a 202 with a prac. I built that building with 202 funds. During that process, I built the building with federal funds, so therefore the federal requirements for procurement would be there. They are there. I built the building with federal funds, but after that, I have a loan guarantee with ongoing compliance requirements and a prac. And the prac would not necessarily, what would that have it? Well, oh, sorry, it opened here. There you go. Let's look at the Section 8 cluster. Procurement, suspension, and debarment is not marked yes under Section 8 cluster because there are no awards being charged, or there are no expenditures being charged to a federal award. We're just charging the subsidy. I mean, it's just subsidy comes in. The expenses are not charged to an award. They're being just charged to the building. The award is paying for less's rent, not cost reimbursement. Now, if I'm in public housing, that's a whole different story because it is a cost reimbursement world. Capital fund, public housing, things of that nature. But in multifamily housing, 202 or 811 in particular, where we have these, it's marked yes because the building is built with federal awards. At that time, that purchasing is all in place. But in a ongoing mortgage environment where I'm not doing anything, does that mean I have to follow this? And my argument would be, yes, it's marked yes, of course, but it's not direct material to the program in years 2 or 3 through 40. I'm not charging to an award. None of these expenses are going to a federal award. The only thing we're listing is the beginning balance of the mortgage at year end and the amount of subsidy we spent during the year, and subsidy we already can tell based on the cluster is not something we're charging an award to. So that's my theory here, Stefan. I think at this stage you're better off to argue, especially given what's really happening with the requirements. You're better off arguing that we're not really charging to the award, and arguing that yes, it is a requirement, and there's a reason for that because the building was built with federal awards. And that is why you look at activities allowed or unallowed, or we've now taken the allowable cost and cost principles out and married those together, okay? And I'll explain that in a minute. This whole thing here, modest in design, not include infirmaries, nursing stations, providing only the necessary services, that's really for the prac. But that's the answer where we get to from, capital advances and 811s. Well, sorry, 202 and 811s, the capital advance programs aren't charging to awards either. And they're the only ones that we have where I would find an active requirement marked yes to apply procurement. And I don't think they apply in years 2 through 40. That's the argument going on there that you will have to decide whether or not you like that argument, okay? So, Stefan, even though you're required to maintain the building in order to provide low-income housing, you would argue that we're not charged. I would argue that, yeah, here's what we're paying it from. We're paying it from tenant rent, okay? We're paying all the maintenance from tenant rent or the Section 8 prac, Section 8 or the prac, which is really tenant rent. So all the expenses of the building are being paid for by the rent the tenants pay. There's no charging back to anything in a federal award. And that simplifies your life greatly. If you can get people to accept that argument. See, that's exactly why multifamily housing is different. So you just have to write that up at the beginning of your planning process and say, look, all the expenses of the program are being paid by the tenant. Either the subsidy piece or the rent piece. And if the subsidy goes down, it'll be paid by the tenant even more. But either way, rent tenant subsidy is an exchange transaction. We know that it's not a contribution, it's an exchange transaction under GAAP. And so that is where we're marking that line. And I'm probably one of the few people that will tell you that. People might argue Les is a irresponsible nunchuck. Well, I don't know. It's multifamily housing. If I'm in public housing, I guarantee you we're going to follow uniform guidance purchasing requirements. But in multifamily housing, nope. I don't think that is on my radar screen. Now, subpart E, these cost principles. And I'm going to get, Kathy, we're going to get right to your question. I still haven't forgotten that. Okay. I want you to know there's a very specific place for me to deal with that. I just need to type something here. Oh my goodness. To make a Q&A go away. Okay. Subpart E, cost principles. Now here we go. A lot of things about A87, A122, how to arrange the costs, blah, 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 cost allocation plans, yada, 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 yada. Now in multifamily or public housing, and I didn't think about this at the time, but now I'm sitting here. My brain always works differently when I'm in the middle of the class, which is most unfortunate for almost everybody. But if I'm in public housing, I get a completely different vision of how this works. Okay? And I'm going to open up something I do for public housing. I have a little bit of an allocation plan. So you had a proposed budget. And they're trying to figure out, this housing authority has about 500 units of public housing, maybe a 400 or 500 voucher program. I don't remember the numbers of vouchers. And they're trying to allocate out the costs, and they're troubled housing authority. So HUD has got them in a position where they can't pay any expenses until HUD approves each individual item. And they're telling them they need a cost allocation plan. Well, from our perspective, this isn't that hard because the first decision is to remember, and it's the same for multifamily housing. Remember who can be charged front line. Every one of the people in blue is actually a frontline employee. Those are employees that if the project were sitting on a standalone basis, those people would work for the project. And of course, you get maintenance all at the project. And so we're trying to only identify the individuals who would not be there, and that's the executive director and the accounting person. Now, they have a bunch of other costs that they are trying to spread. Okay, and this would go in line with all that. Now, we broke it down using direct labor hours, or dollars, I think in this particular case, on how we would spread the salary, really of the only two people that mattered. Everybody else would be front line, and in multifamily housing, almost everybody is front line. So the only time that matters is if I'm at a nonprofit that isn't running, that's running the entity itself and not collecting management fees, which is very rare. Most of them are collecting a management fee. So we would go ahead and allocate those costs, and we spread them according to how, the number of tenants, direct labor hours. All of this was what essentially was required by uniform guidance to come up with that. It's very simple. Now, the older requirements had this after the fact, account for total activity, be signed, prepared at least monthly. That was fine. And the new requirements would be that it's supported by a system of internal control that has some ideas about accuracy, allowable costs, and being allocated properly. And then be incorporated into the official records, encompass everything, so all the costs are being spread the same across federal and non-federal programs, and we would ultimately get to this level of being able to do that. So time and effort reporting is a big deal. Now, we would get down to salaries and wages must be based on records. Now, most of the time, our site people work there, our maintenance people work there. On small projects, we may be allocated, or they're charging some process, by time. Almost all multifamily housing will have some charge for the direct labor employees that is easy to track. So you're looking at the list of requirements on 24, and do I really have to change? And the answer is, well, not necessarily. Because what's really going to happen on slide 26 is we're going to start talking about direct costs and what's allowable. Now, in our process of the regulatory agreements for multifamily housing, we are told that the project should only charge those costs that are direct and reasonable, and their frontline costs. And they give us a description in handbook 4381.5. And again, I was not thinking ahead to that, but I'll just put that in your materials right now because I have this broken out for all multifamily housing. And it's pretty specific, and this is going to lead us to ultimately the next conversation. Assigning management costs. Okay, here's the relevant pages. It's 9 pages. What can be charged to a project? And I'm just going to scroll through here. Look, frontline costs. This was exactly the same as uniform guidance. You can charge things, they were listing on the slide the direct costs. So HUD is defining for you the direct costs. So we're seeing these charged to projects. Then they have things paid from the fee and things paid from the project account. Now, what do we get out of this? For me, what I get out of this is that some things are to be paid from the fee, and that fee essentially represents then what? It represents the indirect costs. I'm just saving this down here for you. And what we're going to get out of this in the end for all multifamily housing is that when you look at this, you are not worried about these requirements because you are not breaking out all the costs that are being charged to the project are direct, with the exception of one thing, and it's the management fee. And the management fee accounts for all indirect costs. And by HUD definition, under the handbooks for HUD itself, that management fee is a proper allocation of the indirect costs. So in multifamily housing, unless you're not charging management fees, if you are charging management fees, you do not have to worry too much about the cost principles. All you're really saying is, we're allocating the indirect costs through a management fee, which HUD has already approved. As long as they're charging to the approved management fee. And you have the documentation for that. Now, okay, so public housing versus multifamily housing. Public housing is a process or another set of programs where the buildings were actually built by the federal government and for a while ran by the federal government. When the federal government decided that it couldn't run those, surprise, surprise, they spun all of that asset base off into the local communities and told them to organize a public housing authority. And that is managed under public and Indian housing in HUD. And it's essentially a competitor to multifamily housing, although we really don't think of it that way. So in public housing, we have allocation plans and we have similar things, but we've moved them over to management fees because we're trying to get them all to adopt the multifamily asset management model and live on fees rather than allocation plans. And if you're looking at, what's the best way I can probably get this described quickest? Hang on, I'm going to just share something with you to answer your question. I apologize to other folks here, but I probably have a lot of newer people who don't probably understand what I am referring to. And I'm just going to open a different slide for a second. Okay, inside HUD, you have a lot of things going on. Our conversation today is pretty much focused in housing. The public housing is on the opposite side. It's kind of interesting to call it a polar opposite. That is public and Indian housing. Public housing, the buildings were built by the federal government, ran by the federal government, ultimately distributed down to local city or county governments, and ran locally now, where the county owns the buildings or the city, whatever, the housing authority owns the buildings. HUD provides a subsidy and a capital component to keep the buildings updated. And they also run a Section 8 project or program that is more tenant-based. So you would call public housing the projects, okay? Multifamily housing is split into kind of different things where you have the loans and you have a subsidy program also. And you have a few things running down here like the 202 grants or 811. And so you get, these are mostly, multifamily housing is mostly based around HUD insured mortgages where HUD does not give you the money. There's no federal award. They just insure the loan. It's called a federal award under the definition of federal awards, which is really moving into Kathy's answer here in just a minute. But that's the main difference. Multifamily housing is owned by either a nonprofit or a for-profit owner, individuals. They're ran under a different model. And frankly, we're trying to convert more public housing over to the multifamily housing model because it's just tremendously more efficient. If you need a little more clarity or an answer there, let me know, okay? So at this time, we're basically saying for multifamily housing, don't have to worry about cost principles too much because for the most part, we're charging management fees, and management fees are covering the indirect cost component of most programs. So there are no indirect costs being charged individually. They're all charged through the management fee. Now, on a nonprofit, under uniform guidance, you may not be charging the management fee, and you may have a cost allocation plan that would require auditing under this subpart E, okay? But the majority by far are out of that. And then we said we had to have reasonable approximations of the activity. Internal control, did I have to change? No. And we were into direct cost is where we ended that discussion. And we are allowed to charge administrative support in some cases. But as far as I'm concerned, in subpart, for multifamily housing, subpart E is not all that applicable for most projects. Only ones that would apply would be nonprofits that are not charging the management fee. Now, of course, we're here for nonprofits anyway, so it wouldn't be the for-profit guys, no matter what. But if you're charging, a lot of nonprofits are being ran just like a regular multifamily housing, charging a management fee. And of course, you have the ability to use the indirect cost rate. We're not using that. That is a specific statement in the CFA anyway. And we can use management fees. They're negotiated, HUD approves them, and you come back to that conversation as you work through it, okay? So indirect costs, no, we don't have a negotiated cost rate. We are really just using a management fee, which is defined in another section, has an allowable way to do it anyway. So as far as HUD is concerned, everything is working there, but we do probably need a few and by the way, the management agent is signing the certification. So if you're looking at the certifications listed here and on the next slide, we are using those certifications in other places. They're just a little different. At times, the nonprofit will probably be filling out some of these for other grants, things maybe related to some multifamily housing forms that might be filled out, but the management fees are usually the prime charge. I haven't done a survey of all of our nonprofit submission clients, but I think if I look back at the last survey we did, the majority of them charge management fees. I think it's way over 80 to 90%, okay, at that time. Okay, now that transitions us into the meat of this conversation. You've got through all the other uniform guidance things that are terribly important to every other segment that uses uniform guidance. So please just take a second to realize how unique multifamily housing is when you compare it to other areas in uniform guidance. And this is why we've had problems in the study I showed you at the beginning of this, where HUD is different and they're giving us all these negative comments. And a lot of that is just the lack of recognition of differences in multifamily nonprofits versus all the other nonprofits we do. And you're going to see that throughout the testing. I mean, you'll see it in sampling, the ideas of dual purpose sampling, and I'll talk about how the AICPA views some of those things, not so favorably, by the way, but they, and there are reasons for it, but none of those reasons really apply to multifamily housing. And we'll get to that as we continue our sojourn through these requirements. And I know we're getting close to our break. So when you get to subpart F, we get the information, and this is something that no matter what we do in multifamily, this stuff applies equally and just as much as it does to any other single audit, okay, under uniform guidance. So subpart F is going to give us the basis for determining expenditures, which we're going to answer Kathy's question here. And then it's going to talk to us about a couple of other things. And this is just the general nature of what we're dealing with here. What the costs, how to spread the audit costs, what are the auditee's responsibilities, what are the requirements under the auditor's tool belt, and what needs to be documented. Now we're going to break this down into subsections. Now I've highlighted the ones where I highlighted, bolded. I bolded the ones where we have a little more specific traction, although I will address most of these areas at some level as we go through the next hour and a half. So, but if you look at why I bolded a couple of these, well, obviously the basis for determining federal awards is always a bit of a challenge. And when we get to multifamily housing and people are transitioning from something else to multifamily housing, there are always questions that arise during this process. Now, audit costs are another thing. In general, aren't that specific to multifamily housing, because HUD's going to be very tight about what they require, and we'll change that as we move through this conversation. The financial statements themselves are pretty well defined, but audit findings are a problem. So 516, and then of course the most troublesome areas 18, 19, and 20 turn out to be kind of the big planning areas, and we don't want to mess that up. And we get caught on a lot of things in 18, 19, and 20. However, the peer review checklists are fairly comprehensive and reach across those boundaries fairly easily. Okay, let's just look at what the auditor is required to do. Now, if you expend more than $750 or more during the year, you require a single audit. If you expend less than $750, you are exempt from single audit. So, Kathy, here we go. And we're going to have several iterations of this conversation, maybe. There might be other people asking questions. You have a HUD-insured mortgage for $900 at the end of the fiscal year. Well, let me just say this. I don't really care what my mortgage is at the end of the fiscal year. Now, we're going to get down to the next page. Let me just skip over there real quick. When you look at the third bullet, in fact, I'm going to just pull this back, hang on, and make a change here. I'm going to highlight something just so it's very clear. Oh, that was really interesting. That was not what I thought I would do. For this particular conversation on your question. Okay. When we look at the awards, we're going to then look at the outstanding loans with ongoing compliance requirements at the beginning of the year. Okay, Arthur, I can share the peer review checklist. That's not a bad suggestion. And they're going to, by the way, these checklists, Arthur's a peer reviewer, so he's mentioning these. These peer review questions are going to follow right down this list. So, Kathy, here you are. You have a $900,000 mortgage at the end of the fiscal year, so I'm assuming it's 900 plus something else. Maybe call it $30,000 or $40,000 at the beginning of the year. So mortgage balances with ongoing compliance requirements are measured at the beginning of the year. Okay, so at that point, you are a single audit. And you are paying your own mortgage. You don't have, you receive a little Section 8. So I would say the combined awards are, let's say there's $100,000 in Section 8. So that would put us, and I'm just assuming maybe a $40,000 increase to the mortgage at the beginning of the year. Maybe you're paying down 40. So 940 on the mortgage plus 100,000 in Section 8, whatever the number is. That's $1,040,000. We're over 750. We have a single audit. Okay. Oh, your own mortgage 30,000. So let's put. I was reading that a little wrong. So I'm at $1,030,000 a year. Okay, that for this year, that is a single audit. And it will continue to be a single audit until you fall below the combined $750,000 threshold. Okay? So that is a single audit. It is also going to be a consideration for the major program because you're over 750 there also, but we'll get to that. Now, the major issue here that people generally have is that the loan is considered outstanding or a federal award throughout its life because it has ongoing compliance requirements. And if you're looking at that compliance requirement and you want to know, sorry, I'm just going to go up here to the top of this and maybe bring something else over on determining federal awards. Okay, let me pull this page over. I don't have it organized correctly because I just use this. So I can make this a little bigger. Determining the award expenditure, loans and loan guarantees. And it says risk of loans until the debt is repaid. So to calculate the value of new loans plus beginning balance of loans for which there are ongoing compliance requirements plus any interest subsidy. We do have some interest subsidies there. Hang on, I just want to get to this different. Oh, that's not working. It won't let me highlight here. Okay, because it's secured document. When you look at the regulatory agreement, it clearly outlines reserves, distributions, it has cash receipts, it has cash disbursements. If all those things are going on here, that gives you a ongoing compliance requirement. And so these loans stay out all the time. Now, what happens when you go below 750, Kathy? You have a regulatory agreement that requires you to have an audit. And that regulatory agreement doesn't really break down when that audit goes away. It just says you audit till this regulatory agreement goes away. However, HUD has decided to make life easier for you, and we have issued a housing notice. And I think that's imperative to sort of discuss. It is, geez, Les, I had it right here the other day. Where did I do with it? I'll get it out at the break. Oh, here it is. Notice 2013-23. Now, this was this was talking about 500,000 at the time. Before we went up to 750. And of course, they're going to discuss that down here a little more about how this works. But when you go below that limit, below the combined limit, you're going to go into a process where you're going to submit only an owner certified submission because uniform guidance does not want you to charge an audit to a project when an audit isn't required under uniform guidance. So HUD is transitioning the regulatory agreement that once you go below 750 combined awards, you are no longer an audit. You will file an owner certified submission. And you're certifying that you received less than 500. That's a for-profit side. It would be 750 on the nonprofit side. For us either way, and so you would be out of it. And that works for the nonprofit or for-profit side either way. It's just they changed the threshold under uniform guidance to 750. Okay? So you would still have an audit until the combined awards go less than 750. Now, if you're over 900, but no program is over 750, we'll have another discussion about that about what would be your major program. But as long as you're over combined 750, you are an audit, and it will be done. Once you go below, you're an owner certified, because the compliance requirements tell you need to submit financial statements. It's just modifying that to fit uniform guidance. And even on the for-profit side, when you go below $500,000, we will exercise the same process. Okay, now you look at the other awards. So if we look back into this, we really don't have a lot of subrecipients. There are some multifamily housing projects that can be subrecipients, but I don't know of any project in general that has too many subrecipients. They may be a subrecipient in some cases, but for HUD purposes, you're almost always, the entity getting the awards. With other programs, you may also be a subrecipient, which adds that responsibility in here. Now, one thing that's terribly important is the last bullet on slide 36. This part does not apply to for-profit recipients. I get this all the time, for-profit entities being told by another governmental agency that they must have a single audit. You cannot do a single audit on a for-profit recipient. You can do alternatives, but you cannot do a single audit. And I have 5 or 6 of these requirements hanging around on any one particular time, people emailing me about it because the state agency says you got to have a single audit. This does not work for-profit people. So the agreement for the recipient from the pass-through entity must describe applicable compliance requirements. And sadly, what most of them say is you will file a single audit. Well, you can't. So you will do a derivative of that, generally with a yellow book twist and audit compliance under the yellow book. But you cannot issue a single audit. Okay, we get it all the time in multifamily housing. No, 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 no. Not only no, no. Okay? Don't break a bigger law to make one other entity happier with you by, oh, we'll just do what we need to do. No, no, don't. So I think that's why I quote 501 all the time. And I probably should have highlighted that. Just when I put it in there, I'm not thinking about how all my questions come across, but that is a very big deal. You cannot get that out of your mind, or should always put it out of your mind. If you're a for-profit recipient, you are not a nonprofit. Do not tell anybody you're going to file or do a single audit. Okay, so you get the list of loan guarantees. I have a nonprofit entity. So this is, I'll answer this question right here because I think it's a direct impact. And the peer reviewer, Arthur, he says, yeah, if they do that, it is a non-conforming engagement. And that is exactly why I tell everybody not to do it. Your peer reviewer, if they find out, will not be happy with you for having done that. At least they shouldn't be if they're awake. If you told me, yeah, I did a single audit, and you list it down and they come to it and they're going, hey, what is this? And they're going to say, well, it's a for-profit entity. Yeah, you're going to get an unhappy emotion in the next 15 or 20 minutes after you tell them that. Okay. Now back to Stefan. If you have a nonprofit entity receiving rental assistance, is the assistance considered expended just by being received by the entity? Or should you use the cash basis rental assistance revenue to determine the portion of the expenditure? Or if the nonprofit has a net surplus, would the cash basis then become expenditures for federal awards? Oh, Stefan, that's a great question. Absolutely tremendous question. So here's the thing. Now, I imagine there are differing opinions on this, but here's my opinion. Subsidy is received and expended when it's received. Okay. And remember, subsidy is tied to the individual. So every time HUD sends you subsidy, they've already agreed to pay that amount for the rent, that person's rent, in the next month, whatever that is. So January 1st, the subsidy arrives. They're paying subsidy for Les Sparks' rent. So the minute you get the money, it's expended. Now, you might have money HUD owes you. So you get to the end of the year, and the process of Section 8 is driving a series of receivables, or maybe a payable back and forth. It would be what you expended. So if you have expended the money and HUD is owing you money now to pay for it, I still think that, to me, would be the expenditure. However, let me just say this. It'll be really small amounts, okay? That should be very small amounts where that doesn't match. But rental assistance is usually, for all intents and purposes, cash basis. If you were looking at, let me bring something else up from my normal multifamily class to help maybe explain that. Oh, I'll pull this over into another location. Update, multifamily update. Kathy had a thing here for this. I just think it's going to be a better. Okay. This is from a system called Trax in multifamily housing. They tell you the amount they're paying you on the date they deposit it. Your federal awards should pretty much equal that. Now, if you have a receivable, HUD owes you money. I do not mind calling that there. But the surplus for the year, how do you know that surplus didn't come from the tenant portion of rent? So we never count on that surplus being unexpended. So even if HUD told me I had to put residual receipts away, I would not call that. I would not deduct that from my expenditures, because it could be the fact that it's a tenant portion. The whole tenant portion, we're considering the HUD portion expended first. So all subsidies expended first dollar in. And we generally don't have too much of a reconciliation on subsidy for that. Now, in public housing, I would have that more. Okay, I get money I don't expend. So HUD gives me the money. I haven't spent the money. It's in reserves. I have that all the time. But in multifamily housing, we hardly ever have that issue. But the idea is expenditures, okay? So I would think it's always keep it down. To me, it's essentially, you could call it cash, but that wouldn't account for the idea that I might have spent cash that HUD owes me for, and it's legitimately owed Section 8 money. I don't mind calling that an expenditure. Okay, that could be the only answer there. Okay. Now, I think I'm going to take a break, and we're going to come back. I've got some other things here coming in from the peer review gentlemen, and I want to address each of those as we move in. But I think we're at our break time. We're going to take, I'm going to give us 40. We're going to go till 11:55. That's 14 minutes. That's going to give us about I want to keep it on the minute there. So I'll set a timer here, and we'll be back at what for me would be 11:55. You can do the math from here, back 2 hours or ahead 1. And we'll be back at that time. Okay, everybody, we're back. 100 more minutes. I got up out of my chair enough to see that it's snowing outside. It made me cold. So that was good. Like that weather happening here today. Okay. So we were ending on page 30, on slide 37. And I think we finished with the idea of how we determine federal awards. Now, the only issue is really just deciding loans. Now, one other thing I have to bring up. There are home funds or CDBG funds that may or may not become federal awards. What you have to do is decide whether or not there are ongoing compliance requirements. That is the trick. Okay, so there are a lot of these other things that are unique. And you have to determine, and that those compliance requirements, if you are moving into the Q&A, and I'll put the Q&A for single audit into the materials folder. I don't remember if there was an actual question about that individual thing. About determining federal awards expended. Oh, 500. I hadn't paid attention to that. No, it must be based on the activity when the related award. Does it require the determination to be based on accrual or preclude basis of cash? And this actually answers Stefan's question too. It said, no, it doesn't make any difference. You make the determination in accordance with 502, whether the accounting method was cash or accrual. So you get to decide that. But it didn't really tell us anything else about federal awards. So my point is just this. It has to be something more than actual financial statement filing requirements. That's the consensus we would generally see coming out of that, is that nobody would have probably said, "Ooh, we got a requirement," if all it was to file the financial statements. And there are plenty of those with audit requirements, but I don't think most of us would agree that that constitutes ongoing compliance requirements. So keep that straight. That's the only question that I see coming up in most cases of multifamily housing that would cause anybody unusual distress. Otherwise, it's straightforward. Determine when that occurs. Oh, it is 75 and maintain. Yeah, my daughter tells me it's just hotter than Hades in Mass and Connecticut, where she lives, but it's more Western Mass. Okay. Do you aggregate related party-owned properties for determining the 750 threshold? You know, William, there was going to be somebody who would ask me this question. And we just as well get it over fast. Okay. That is a very, very, very good question. And if I'm going to, I'll answer that. Hang on. I thought I had something broken out here where I just had subpart F in there, but if we go all the way down, I think I've got it over here. Hang on. That's an excellent question. No, that's this one. That's the supplement. Section 8 cluster. I don't see it here. Open Sesame. I just had it open here a minute ago. I just created one. Subpart F in general. Okay. Now, this is a it depends question. And it's going to get down into this section. I wanted to just make sure I got to the right part. Now, an audit conducted according to this part, and I was just thinking it was somewhere else. Program specific exemptions, contractors, for-profits. Man, I just saw it here a minute ago. Anyway, what it's going to say is it's going to depend on how you decide to bring this in. And if you have a compliance, other programs or so let's say you got multiple projects at a nonprofit, you have the choice of actually, doing a single audit on those projects at the nonprofit level, in theory. That's why a single audit is a good thing. Single audit being done once. Now, the problem with that is HUD puts some constraints on that that are interesting. So for HUD purposes, if we're talking about how that works, we would come to another place for guidance. And that guidance would be related to submission requirements. Now, HUD has this document, and I want to just start here. This isn't really the answer for all of your questions specifically, as far as I can tell. But when you look at nonprofits or more, okay, let's just get down here. They have the ability, and they discuss the same things going on here. As old as this is pretty old. But they have to have the, sorry, I missed it, consolidated statements. Okay. Nonprofits. The consolidated submission for nonprofits may include operating information for non-HUD businesses. For example, you may own a thrift store, rehab, or other things, right? And they may submit a consolidated financial statement that covers both HUD and non-HUD operations. The non-HUD operations would be in the consolidated, and the HUD statements would be separately at program level supplemental. Now, the next answer for all this consolidated thing would be brought up into here. If HUD projects are involved, multiple HUD projects, as if they share different TIN numbers, then they have to be submitted to HUD separately. Despite the idea that you could theoretically submit that as an owner certified, or not owner, gosh, owner certified. You could submit that as a consolidated single audit. So related party owned properties for determining the threshold. Oh, now you're going to get to me. Now you're going in another direction for me here. I just realized maybe what you're asking. If we are in housing notice that I brought up, did I close that already? 2013. Now, I just reread that again, William, so I apologize. I get a little strange when I start trying to do things, typing and looking for things when I'm online. It's like I've become an incompetent fool. So when you look at this, HUD's saying, look, specifically it relieves the owner of things here. Owners will be permitted to submit owner certified statements provided they receive less than combined financial assistance for the owner. Now, under this guidance, HUD would tell you, that's how they've defined this, by the way. You could go look at any other place where this happens. And we have tried to get around that rule. But if you have multiple projects under an owner, even if they're separate TIN numbers, HUD's going to look at the owner. And that's why they brought up here, and I highlighted this particular thing, the owner is under an obligation to submit an owner statement but receives less than 500. They have interpreted this to mean that if the owner has 3 projects that individually are under 750, but combined are over 750, that owner needs to file a single audit. That's HUD's interpretation. And they've done that at the ownership level. Even though the projects individually could go under single audit on their own. Now, uniform guidance explains that you, the owner, decide what your reporting level is, and you can include projects or other entities that might have their own single audits. So there's a two-edged sword coming out here. One is HUD's, and HUD says we're going to aggregate things at the ownership level. Now, what happens in most of these cases, when this first came out, we would tell people, look, you can probably get away with this by saying, look, HUD's got you open as their own tax ID number. Project A, B, C are all different. Go ahead and claim that they're under the limit and see what happens. And we did that for a while. HUD came back and told the owners, ooh, we don't like what you just did there. You are a bad problem for us, and you need to get these audits done because combined the owner has them over 750. So they have a system to be able to tell who the owner is, and they're aggregating the owner's projects together. So that might be the question you're actually asking me. And that is answered in that same housing notice 2013-25. I'm just saving it down to your materials right now. And you should have it there now, but I can tell you that that is how HUD interprets it, and they have forced people back into audits. At an overall level, even though they were all under, each individual audit was under the single audit limit, and it worked either that for both nonprofit and for-profit. So we saw it both ways. But that is how they interpreted it. The ownership, the overall calculation of that limit was done at the ownership level. I have a grant that has a CFDA number for Medicaid and appears to have continuing requirements. Is this still not subject to UG? No, if you have a CFDA number and it has ongoing compliance requirements and it's Medicaid, Greg, the only thing I'm questioning there, you have a grant for Medicaid. That's different than normal Medicaid payments. So I would have to look at the grant agreement. Certainly, if you have a grant and it has expenditures in the current year, I would make the. I don't know much about the Medicaid program that you're referencing. If there's a compliance supplement on it, we would have to look at that. But I would assume that it has ongoing requirements. Now, if it's a grant and not a loan, so in those cases, the grant would be expended in the year, but in the next year, if it wasn't expended over 750, we would not have that going on. So, okay. So the client is a for-profit owner. Okay. Sorry, I just got another question. The answer came back on that. So William, that's good. Now, Greg, I think if you are over the limit and you have the expenditure in the current year and it is a grant, then you have a problem. It's subject to UG guidance. If it's truly a grant and not a loan, but the expenditure was in another year, and then you would only be measuring the current year expenditures under the grant. Like I said, I'm not too familiar with the Medicaid program, what we're really talking, what that is. But if it's a federal award under a CFDA number and it's an expenditure in the current year, or you spent the money, right? Let's put it this way. You got the grant and spent the money, then you have a federal expenditure that requires audit. Okay, now what if only one of the projects fall below the threshold in the example? Does the entity need to be audited? Let's see. What if only one of them falls below the threshold in the example? Does that entity need to be audited? Well, in the example, if the owner owns them all, okay, under this thing, then the owner's combined assistance is still over the threshold and therefore required to be, each project is required to be audited. If in HUD, if they were aggregate below, so let's say I had 4 projects, owner X owned 5 projects, 4 of them are at $1 million and 1 of them is below 500,000, and it's a for-profit. Then the answer to that guideline is typically HUD would say you would have to be audited. I'm going to tell you though that you're going to audit the other 4, and I would let the other one go below the limit and see if I got caught. It's a real squirrely little thing. But you did file the other 4 because they were over the limit anyway. HUD may come back and say, ooh, that needs to be audited. I don't know. But here's the next question. Is it really worth it to have to go back and fix it? You know, those are the questions you have to ask yourself. If I'm over the limit, and this the notice I'm looking at, you're looking at on the screen, if that owner is the same owner and it goes below the limit, HUD would probably tell you it had to be audited. But because you're auditing all the other 4, you may be able to skip out on that and the system may not notice. So I don't know how they would see that. I mean, I think I know how they would see that, but you could maybe get out of that one as a particular conversation. Okay, now, any other questions on federal awards? That I knew that would be a sticky wicket, if you will. And there are places where HUD discusses the reporting entity, and there are options available for combining or uncombining entities in single audit, but there aren't that many options in HUD. If they share the TIN number, they can be combined. If they do not share the TIN number, they're separate audits in HUD. And that's the way it is for all, for-profit or nonprofit. Okay. This part conducted, and this part must be in lieu of any financial audit. So we'd be limiting the other requirements for audits. If some other agency wants one, they're going to have to pay for it. Okay, now frequency every year, unless you're under some biennial audit requirement. I don't even know why I put that in here. I should have just, they're going to be done. And you'd be under sanctions. In fact, let me say it this way for this slide here, 504 and 505. If you do not file these audits, HUD will take you, I'll come back and answer that. Sorry, there was another question popped up here, but just as I scrolled on to the next slide, but I'll come back and get it in just a second. If you are unwilling or unable or whatever, otherwise not happy to do this, HUD has a very strict, what's the word I'm looking for? Method of enforcing this behavior. And it's called civil money penalties. In this year, when you fail to do that, HUD just went through, there was just a recent change to this PDF for civil money penalties. And it bears paying attention to how this is, looked at from HUD's perspective. Multifamily housing. And it seemed easier to find the other day. Oh, sorry. Just let me look for HUD. It's kind of gotten squished up here. Multifamily, I guess, is the better way. It's not showing up here. It's $55,000. I'm 53,222. I'll find it here just by looking at the number. Oh, why did I get this? I don't remember the USC number, but it's 53,222 or something like that is the civil money penalty, and they can go up all the way to a total of, I don't know how much, but it's a lot. And I seem like I've picked the wrong one here, but it's up to $53,000. So civil money penalties are the jam here. So when you're looking at HUD and influencing this stuff about failing to file, there are huge sanctions. Forget uniform guidance. HUD's going to whack you with the civil money penalty for that. Okay, now you can always charge the cost of the audit down, except unless you're under $750,000 and you don't need an audit, then you can't charge the audit to the federal award. But as we know, you already are not charging the audit to the federal award. So in multifamily housing, not much of an issue. Now, Stefano, coming back to your question on expenditures, is this on a total expenditure level or on a program level? Well, let's go back to the notice. And you can just see it again. Oops, wrong one. Owners of small multifamily projects. The term small housing being a project for the owner is under an obligation. Owners will be permitted to submit financial certified statements provided they receive less than $500,000 in combined federal assistance. So there you go. I think it's not just HUD expenditures, it's all expenditures. And trust me, nobody likes this definition, by the way. I mean, I guess HUD likes it, but every time I tell somebody this, they grumble. But when you don't follow it, more often than not, HUD catches it and asks questions. We've had this experience a lot. We started off in completely different place than we are now, just saying, look, it doesn't really... Come on, there's no way they can catch it, and it's under 500,000. But at the owner level, they seem to be able to know. You just take your chances if you don't follow it. So I would think, to me, that notice is everything aggregated for the client at the owner level for all federal awards. Okay. And if there's bigger questions later, email me, okay? It's probably easier just to email the specific issues as they come up, or even deal with the client a little bit on that. There are other things we can do to pass off some of that information. Okay, now auditor selection. Now I include this for one particular reason. It's the only place where we really have a compliance or a purchasing requirement for multifamily housing. Now, auditor procurement says it must follow the procurement standards in 317. Okay? So the goal is to acquire high quality audits. But what should we consider? And it says this. Oh, by the way, if you look at the third bullet, the federal entity must request a copy of the auditor's peer review report. Now, luckily, very few clients are going to notice that. But if you go to section 509 in the supplement, that's where you're going to see this, and it's going to be an unfriendly conversation at some point for others. I always, in uniform guidance, it's required. In HUD, it's not. In Yellow Book, it is also not required. So in any other place, it would not be required. But the requirement here is for the client to ask for it. The non-federal entity must request a copy of the peer review report. Now, does that mean I should preemptively send that for them if I go into proposal? For the most of the point, I think the answer is it doesn't hurt you to do that. Clearly, you do not want to be in a bad, less than favorable peer review situation. But it just says in requesting, I'm going to read it straight from there, requesting proposals for audit services, the objectives and scope of the audit must be made clear, and the non-federal entity must request a copy of the organization's peer review report, which the auditor is required to provide under GAGAS. That is true, but you're only required to provide it when requested. So in this case, the issue is the client is supposed to request it. Now, my point behind all of this is when you get asked to propose on a single audit, most of the people will not be following the procurement requirements under Section 509. So what we suggest is when you respond with the guidelines of 509 in your response to say, well, we're responding in accordance with your request and Section 509 of Uniform Guidance, and then address your proposal with the responsiveness, the relevant experience, the qualifications, the results of peer review, and price. And let that drive the boat. Now, other people have ideas, but that's the requirement straight from 509. And, should you send that in automatically? There is no requirement. You are required to send it when you requested to provide it. That's clear. But most people probably start getting into the habit of just attaching it. But, that's why there's so much pressure on peer review reports now and single audits. In HUD, that's not quite the same. I mean, HUD Audit Guide is not quite the same. The HUD Audit Guide is not asking you to provide it. It used to, but it's been removed. Okay, now, just the financial statements themselves. And we're not going to spend a lot of time here. I don't know that a lot of people are confused about what the financial statements look like. But you're going to meet, the requirement for the fiscal year. This is where it also talked about this. So 510 was the other requirement that I was trying to find on this discussion about other entities. You may include non-federal entity-wide financial statements, may also include departments, agencies, or other units that have separate audits. So that's the thing I was looking for. Sorry, I can't remember all these little places where they are. Okay, so the statements are going to contain the notes, the related supplemental data, whatever the program requires. In our case, it's extensive. HUD is very clear on the Uniform Financial Reporting Standards. So your financial statement design is dictated more by Uniform Financial Reporting Standards than it is by or through single audit or Uniform Guidance. So then you're going to prepare the statements, the footnotes, and any related supplemental data, which is extensive in our case. Then you're going to attach the CFA, and it's going to be considered supplemental data also, and for which you will give an AUC 725 opinion. Then you're going to have any subrecipients, which are going to be hopefully none in most cases. And then you're going to list the awards expended. In fact, I don't know why I screwed that up. Those are all supposed to be under the CFA, right? They're supposed to be indented. I had this in a different format last night. I decided to change my mind, and I changed the slides, so they should be indented. Those are what's required under the CFA. And we can talk about the statements a little later in a minute. I'm losing my brain. Okay. Now, for loans, in the footnotes, the balance outstanding at year end goes in the footnote. That is important. And of course, then you would have included significant accounting policies, and then whether or not you adopted the 10% de minimis cost rate. So that would be one of those disclosures that consistently shows up in the CFA. And Roy, we'll get to the CFA and CARES Act. In fact, I'm sitting here today waiting on guidance from HUD about the CFA. I just had the first email on that. We'll discuss it a little later. Okay. So make sure you get that right. Now, when we converted, the biggest problem here was the outstanding loan balance at year end, because HUD's guidance in the audit guide is the balance at the end of the year. And UG and rural development, they went to beginning of the year balances. So that's just the difference between the three entities on how they do these. So that footnote balance became a bigger deal as far as we're concerned in the CFA. Now, audit finding follow-up. This is a place I usually do not ask or talk about. But recently we've been having challenges with regard to this. Now, it kind of falls across the board. We have it at lenders, which are not single audit. We have it at public housing, clearly single audit. And we have it in multifamily housing, both the HUD audit guide and the single audit. And both places have similar but different requirements. Now, the auditee is responsible for the follow-up and the corrective action plan. And in fact, most places now are requiring the corrective action plan to be on client letterhead. For all intents and purposes, I would put the summary of prior audit findings and the cap on the client letterhead. I just would. Therefore, everybody knows their client documents. Now, you include the finding reference numbers, the 2020-001, and you have to include in that finding document the first fiscal year the finding occurred. Hopefully, they're not going on for years. Now, the summary schedule of prior audit findings is different in uniform guidance than it is for HUD, or I should say for-profit audit guide. Maybe that's the best way to say that, is uniform guidance HUD versus audit guide HUD. You do list the reported findings unless last year they were already listed as corrected. Now, when they were corrected during the year, the finding only need to list the finding and state that the corrective action was taken. And you can read the rest. If you're still not done, you still have to include a corrective action plan. And that's what the CAP is standing for there, if anybody was confused. It's corrective action plan. Now, if the auditee believes the finding is no longer valid or does not warrant further action, describe the reason for that. And a valid reason is that all of the following have occurred. 2 years have passed, the federal entity is not following up, or a management decision was not issued. That's pretty easy to see. Now, here's my point on this. If you have a finding that has not been corrected, at this position, there is a way to get rid of those findings, because they're going to say it's no longer valid because 2 years have passed. The HUD is not following up, and there was clearly no management decision issued. A management decision is a specific finding issued by the cognizant agency on an issue that says, hey, this is how we should handle that. In fact, it's the last thing listed in subpart F. So the cap should be a separate document and include the names of the contact person responsible. Well, you get the list there, but on client letterhead. Now, when you look at this about what an auditor's responsibility is for this schedule, the auditor is responsible under uniform guidance for determining whether or not this schedule is actually correct. In the audit guide, the auditor bears no such responsibility. Now, We also list other things in the audit guide that we don't list here. We list the outstanding findings from HUD, other agencies, the MOR, the physical inspection. We have all those requirements in the audit guide, but not in uniform guidance. So as we look at that, you do have the ability to finally get rid of findings just because HUD won't, you're going, what is HUD doing? They won't answer this. They don't make the client make the change. Yeah, who knows, right? They could go for 5 years and do that, and all of a sudden one day somebody changes at the account executive level, and then bam, they pound on them. You just never know. Okay, now if the finding's still out, or the same thing is still there, it goes on and on and on, they don't fix it ever, then I guess it's still a finding every year, and it doesn't really go away. Now, report submission. Couple of things here that are important. Timeliness is a big deal. Now, in public housing, if you do not file with HUD before the 9 months is over, the client gets a no score. They lose all their FOS scoring points. There is no such penalty for multifamily housing. In multifamily housing, the penalty is civil money penalties, $55,000 worth, or 53,222. So they don't need any bigger stick than that. Now, you're supposed to get it submitted to the data collection form, or well, have all of it done within 30 calendar days after the receipt of the auditor's report, or 9 months after the end of the audit period, which is, the final limit. HUD will not extend those, by the way, necessarily. And you have to make copies available for public inspection. And that means that for the most part, you have to clear out your PII. Now, I was going to go out to the clearinghouse today and pull down audit reports, but as of the break, Kathy and I don't get in here every day into the clearinghouse, and as of a half hour ago, the clearinghouse has not reset our passwords, so neither of us are able to get into the clearinghouse today, and we don't know why. But you have to go ahead and make sure two things are there. Your package is is searchable, and you have to. They have a routine to check that. But the main thing I get concerned about is not scrubbing the package for PII. Okay, and it goes to the clearinghouse, and I don't think I kept the clearinghouse open because I can't log into it anyway. So that's a big deal with getting the package filed. Now, when the clearinghouse is not filed, here's a question we get a lot. Hey, Les, they didn't file their data collection form on time. Isn't that an automatic finding? No, the answer is it is not an automatic finding. We're going to see the finding criteria here in just a minute, but that will not be one of those criterion. What it is a reason for the client to not be considered a low-risk auditee in the next period, but it is not an automatic finding. So, filing all of those documents with the clearinghouse, I'm going to come back and address that once we're kind of through the next few slides, or more towards the end, okay? Most everybody knows to get out there and file that, but needs to be done timely. Otherwise, you don't want to be the reason the client isn't meeting low risk auditee status, even though, honestly, frankly, it just doesn't matter. In multifamily housing, being a low risk auditee is just almost a zero factor, and I'll explain in a minute. Public housing, big deal. Multifamily housing, generally not a deal. has no impact on the audit. It's just like the red badge of courage sign. Hey, we qualified as low risk auditee. Yay! That's about it. You can pat yourself on the back. Sorry, I don't mean to be too facetious about that, but okay, scope of the audit. Everybody understands. There's no reason to spend any time going on about this. So the same thing going on here. The CFA and the statements and the supplemental. So the statements and the CFA are presented fairly. That means the financial statement opinion and the AUC 725 opinion are unmodified. So we're happy to see that. Oh, of course, it doesn't mean they're going to be unmodified, but they should be. Internal control, you follow the compliance supplement. And the main issue here is that you must plan on achieving a low control risk over compliance. Now, there are a couple of questions. I'll come back up here for most of this. I'll get back to you in a minute. Both Jamie and Anonymous. Okay, I'll get to that in a second. The goal here is to get testing of internal control over compliance done, and it has to be to low. Now, the dilemma for all intents and purposes is that when people come into CX 7.1, and I'll just bring up that form, we know we are, oh, that didn't work out the way I wanted it to. Sorry, my search engine's dying here. Okay, let me pull this over. Now, this has really nothing to do with single audit for all intents and purposes, but it's really related to HUD single audit. Okay, you come down here and you have a CX 7.1, and the general consensus is we're going to get to controls at high. Now, if you tell me on the other screen that I have to assess control risk to low for the major program, and the major program just happens to be that darn loan program, is there any way you can tell me how to segregate out the financial statements from the compliance when the financial statements under HUD's opinion, the financial statements are the compliance? There is no exception here. Cash, the financial statements, I mean the fixed assets, the reserve for replacements, the escrows, all are HUD compliance. If you have to determine that those numbers are being tracked and reported correctly for compliant, they're all compliance components, how do you get to single audit saying you have to go to low? How do you go then turn over to the financial statements and say, oh, we're high, when those controls are exactly the same? For compliance, you know, maybe there's a few that are different, but for the most part, HUD sees these controls being exactly the same, and the cash is the cash, the reserves are the reserves, the fixed assets are the same either way. They're all under compliance. All receipts are subject to compliance. All cash disbursements are subject to compliance. Well, how can be determining those in the proper accounts or all these other things be different than it is for HUD? Or I should say, yeah, how can you separate those two things? This is the number one problem with multifamily housing. We are completely tied together in a way that nobody else will ever be. Other single audit programs are not tied that way, okay? So it's very hard to segregate internal control over compliance and internal control over the financial statements for a HUD multifamily project. You can say it for the RD too, any multifamily project, because the compliance is, the financial statements are the compliance with one exception, and that exception is tenant files, which are the compliance monitoring is not measured in the statements, but every other one of those things, distributions, cash receipts, cash disbursements, all equity skimming is driven by the financial statements. And to do that, you have to have them in the right buckets. You have to know, the accounts are good, so classification. You see my point. This is a real trouble for compliance in multifamily housing, and in particular because you are required to get to low. And the only way not to go to low is if you're ineffective for compliance, which would mean you have to have a finding. And then you would assess risk at maximum, and sampling would be off the chart. You'd be at 60 instead of 25. And there's no motivation to really go there. Now, we're going to audit compliance with the 12 types of compliance requirements that have a direct and material effect. We've already talked about one of those where that would not be the case, such as procurement in the 202-811 programs. Okay, now, we have a conversation going on here about remote auditing, EIV, how will we get tenant files, things like that. Now, the compliance supplement doesn't mention any of those items, and they've had plenty of time to update it, by the way. So that's at least 7 to 8 years to put EIV in there. And I'm getting to your other questions here in a minute. So if things change that are not reflected in the supplement, the auditor must determine the current compliance requirements. But what if we know those compliance requirements aren't different and they just haven't been elected? HUD has not elected to put those in here. Now, the next problem is important because this is the crux of what we're going to talk about in a few minutes. What happens when programs aren't in the supplement? Well, guess what? About 90% of all single audit things these days, getting to be higher, it's probably not 90, but it's 60 or 70% of the program awards that we're auditing in single audit are not in the compliance supplement because they're all insured mortgages. Has more and more things happen to us in the programs. We're converting out of, say, a 202-811 and into something else. Or we're refinancing out of a 236 and into a 223F. Once we go into those other insured mortgage programs, there is no supplement, as you all know. How are we going to bridge that gap? So if you leave 202-811, or you leave Section 8, and now you're in another program with no supplement, what do we do? Now, trust me, when you look at the peer review stuff, this is a big deal because we have to successfully transition from no supplement or a supplement to no supplement, and how do we do that? And we're getting comments on this all the time. Okay, now, so I just wanted to bring that up there, and it says ultimately then you must include test of transactions or other procedures necessary to provide that evidence. And then it says follow up on the prior audit findings and determine the reasonableness of that schedule. Now, Jamie, you asked this question about MOR findings. We do not have to report those in our schedule of prior audit findings the same way we do in the HUD audit guide audit. They are not part of this schedule of prior audit findings. All they are in this case is risk assessment. So when you get to single audit and you have an MOR, it's a risk assessment tool. And in fact, it might be a good tool for us on the EIV kind of side. We'll discuss that here, and we'll get to specifics. But in our case of single audit, that's one of the big differences. None of those items that are required in the HUD audit guide in the schedule of prior audit findings transition to the uniform guidance prior audit findings. We're only interested in your prior audit findings, okay? Now, since we're talking about Well, we'll get to the cluster in a minute here. Our finding requirements for for-profits and nonprofits are the same. Not quite. And we're going to get to that here in a minute. Okay. We'll discuss each of those. They're very close because they both follow the Yellow Book format, but there are some things that turn out different, and we want to make sure we explain those appropriately. Now, trust me, by the way, when you hear all these comments, and maybe you're new to single audit. I know I have people on here today who are new to single audit. When you get, I have at least one peer reviewer here sending me things that are going to be shared with you in a second. And he or she, there might be more than one or two on here, they're going to tell you the same thing. This is a big deal. How you follow these instructions is a big deal. And you will be evaluated on those peer review checklists based on these same criteria that are listed here. So the peer review checklists are going to ask for much of this data the same way. Now, we hope to not get too much problem into that, but you do not want to be in a non-conforming engagement. And there are many ways, there are more ways to get there now under single audit than there are under HUD. I mean, the HUD checklist, we'll juxtapose the two, okay? Because this gentleman has just sent me all of those checklists, and I'll show you the differences between those two to maybe scare you straight. Go straight, do it all. It's very important. I really don't want to underemphasize any of that, how important some of these things are. Now, the auditor's reports. You get a report on the statements and the supplemental data. You get a report on internal control over financial reporting with compliance, the Yellow Book report. Very similar to HUD. You get a report on each major program. The opinion is slightly different than the HUD for-profit one because you have different references. Instead of the HUD audit guide, you're going to reference the compliance supplement and things of that nature. Then you're going to issue a schedule of findings and question costs. That schedule looks, so you can see how what it must include, the type of the audit report issued. So this is by far more than the schedule of findings in the HUD audit guide. Now, the actual finding reporting is slightly different too, but I wanted to make sure you understand there's a difference in the schedules. The schedule of findings and question costs in HUD is just findings and other, the Yellow Book format and all that goes with that. But in single audit, the schedule here is different. It discusses the type of report issued, the state of whether there were any significant deficiencies or material weaknesses, any non-compliance that is material to the statements, significant deficiencies on the major programs, whether findings were disclosed, identifying the programs, the threshold between A and B, and whether the auditee qualified as low risk. And I think I have one of those right here. This is very standard. Type of report, unmodified, internal control, non-compliance, federal awards, the federal program. Here we are, a major program. This is clearly just an insured mortgage. A-B program threshold, 750, that's the lowest. We qualified as a low-risk auditee. My opinion on the compliance was unmodified. Now, after that, you'll have another piece to this where you actually discuss the findings. So that, in this case, there were no findings. I think that's what it said there, right? No findings. None, 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 none. And I guess I closed my PowerPoint. That was unfortunate. And then you would disclose the actual findings. Now, the schedule of the findings themselves, when you look at it, there are only a couple of differences, okay? And we'll get to that here in a minute. It's very next slide, in fact. So when you get to findings, you're going to have to, there are some mandatory things that are findings. So any material noncompliance or significant deficiencies or material weaknesses or significant abuse. Now, abuse is a yellow book term. Now, you notice we didn't have waste there. We had only abuse. I am not sure you can actually get abuse in the normal multifamily housing project. I'm just not sure it's possible because we don't charge to awards. However, you can behave abusively, and HUD doesn't really get into that in the regulatory agreement. Then, you're also making sure you calculate materiality appropriately. Now, as we move into the new suite of audit standards, we may be addressing how materiality may be viewed differently. So as you look at a revision to AUC 935, okay? And luckily we're not implementing that in 20. So that'll be back into 2021, maybe, right? If COVID doesn't continue to be a significant downfall in our lives. So make sure you calculate materiality. If you went back to George's slides from 2009, what one of those requirements was, hey, you got to calculate materiality. Don't forget to do that at the program level. I don't know how anyone doesn't do that. Now, whether 5% is a good number or not, that's most of the tool set providers are talking about 5%. HUD does not agree with your 5%, by the way. I mean, it's not going to be the case. If I am actually looking back at that PDF, I don't have the CIFA for this. I have it somewhere else here. Okay. So 1.996, right? So $2 million. You can do the math there pretty easy at 5%. So would you think it's going to be seen by HUD to be reasonable that you set materiality on cash disbursements at $100,000? I can promise you their threshold is $10,000 when it goes into the REACT system. So whether or not the tool providers are really excellent at this, or we've revised our discussions as we move into this big audit suite change, and you look at these numbers, obviously I don't have a major program for this Section 8 world, but even at that, $14,000 at 5%. You see the dilemma going on here. Now, there is no answer to that particularly. It's just that everybody is at HUD's at one number and we're at another number, and you better document your number, but don't get too high of a number that you leave things in the statements that HUD just hammers you on anyway with no finding. That's a real dilemma for most of us. Okay, then everything else that was a known question cost over $25,000. So that tells you right away that that's a required finding. Now, I might put my limit at 10 for HUD, but uniform guidance is 25. Now, I've included a very, very, very important comment as the sub bullet there. And this is mentioned in several places in professional standards. As far as compliance goes, this is the only place it's mentioned in an actual guidance document. It's in the single audit area. It's in the sampling guides, the A&A guide for single audit. It's in the A&A guide for sampling. So they tell you this straight up under paragraph 516. When you evaluate the total question costs on the opinion on compliance. So they've just told you a finding is an item over $25,000. Now they're going to tell you how they want you to assess that finding in relation to the opinion. They're going to say the auditor considers the best estimate of the total question costs, and they define that as the likely question cost, not just the question cost identified, which were, known as we know them as the known question costs because we have observed them, we detected them, and those become the findings. So the auditor must also report known question costs when the likely question costs are greater than $25,000 for a type of compliance requirement. So $25,000 is known, but if you get a likely question cost that is over $25,000, then it's also an automatic finding. Now, there are two things coming out of that. One is which was the finding discussion, which was it's not everything over 25 that you see. You have to project what you see to get a likely. And the likely determines your opinion, but it also could determine that an additional finding is necessary when the observed was less than 25, but the projection of that became more than 25. Now, this is only mentioned in uniform guidance as an item, but it's an item in professional standards nevertheless. So UG is just one of these dangerous places where you must make that assessment. So you added up with a finding for question cost greater than 25,000 and a finding explaining why the report on compliance is other than unmodified, or where you think the schedule of prior audit findings misrepresented the status, and you follow the yellow book format. Now, what you don't get out of that, if you read it carefully, and I've tried to do that, I'm not saying I'm perfect, but, read that carefully and make sure you're in the right place. And what you will not find is CFA being filed late has an automatic finding. Okay? So that does, if you file the CFA late, it is not a finding automatically. You can call it a finding if you want, but it is not automatically a finding. You get the list of the automatic findings there. Known or likely fraud. Apparently I can only type no, not known. So this is a fairly significant thing going on. Findings are more dangerous in uniform guidance than the other. Now, when you look at the actual findings themselves, if I were to talk about this, and there is a hang on a second here. I forget something. I thought I had a finding thing here, but I might not have put that together. When you look at the findings, let me just go to the HUD audit guide, and then we'll look at the, I have another document for findings here. When you look at the materials in the folder for this, and I'm just going to go open that right now. You'll see a different format, obviously, because you're going to see it through share file on a web page. But when you look at the findings, here is the, you're required to enter into this spreadsheet all your findings. And it's going to have the text of that. Now, that's not very exciting to see this, and I get it. So you're going to enter, this will be uploadable into the data collection form series. But you want to see the text as exactly as it comes off there, and you're going to list out each finding, and you're going to have content of that finding. Sorry, it opened up in another window. Don't update. Now I'm going to have to shrink this down a little bit. This is what goes up into the clearinghouse, and these are the spreadsheets that you get to load your data in there, okay? Now, the text of the finding is pretty much the same because it follows the yellow book format. But when you are reporting these, you'll see that more goes in there. So you have the finding, so it'd be like 14.155. Oh, I've got a protected sheet. That's so nice. 14.155. Review, unprotect sheet. Oh, my help. You got to be kidding me. Okay. I'll bust that later. I would put 14.155 in there. Now, just one comment about this next statement. And Spencer, I'll get to you in a second. And this CFDA 3-digit extension would be 001. Okay. And then you would have additional descriptions of the programs. Then you're going to have the finding reference number. Okay. You want to make sure that this stays consistent. I have seen these listed in the reports as 2020-01. And then when you go to the clearinghouse, it's a 3-digit thing. So it goes 2020-001. I've had peer reviewers ding people that they were not the same. So, there are peer reviewers on here. They're probably rolling their eyes about what some other numchuck did, but they said it's not exactly the same. And I'm going, please don't tell me you were going to have this conversation. But that's where they went to. Then you get the type of compliance requirement, whether the opinion was modified, on down the list, and question costs are going to be mentioned. HUD also asks you to calculate the question cost. Now, Sanchi, it is very hard. Oh, sorry, I went to the wrong one. Spencer, I'm looking at you. It's hard to pick out the question costs, okay? If you're in Section 8, I think it's impossible to try to determine that. But let's put it this way. You calculate out the difference. In fact, for HUD's purposes, you are only, let's say income was different. You are only required to call that a finding if the income was going to be different by more than $200 a month, or $2,400 a year. So HUD wouldn't make them process an interim recertification unless it was over $200 a month. Now, what's the subsidy on $200 a month difference? Oh, I don't know, probably $30 or $40. So let's say you find 3 of those and you project them to the total population. So that would be $30 or $40 a month, times the 3 tenants. But let's say you then project that out to all the tenants. See, that's the requirement you would be going through here. Now, when you look at HUD in another window, let me just do this. Let me just put a blank workbook in here. Yeah, and wouldn't you know, it opens on the other screen. This is an important conversation. So let's say I had 3 tenants where income was different. See, Kathy or Michelle's having and we're just going to call it by, $225. So I went to verify that, and we were off by $225. Okay, so that's $225 was the question cost, and that would have resulted in a change in the subsidy. Let's call it this way, $75. So that was the diff, and here's the subsidy. So the question cost is really only the subsidy portion. Now, I had 25 tenants in my sample. So the population, sample population equals 25. Sorry, I'll just make this bigger. I know that's unfortunate. I'm probably typing here away going. See, I should have a whiteboard. We're going to adjust to a whiteboard here soon. And then so my difference was 3. These were 3 individuals. 3. The 25 goes here. The dollar value was 75 per occurrence, or for all of them, let's call it $150 a month. Okay, so now I had total tenants of 150 tenants. Well, no, I've got to be over 250 anyway because I'm over 25 samples. So I'm at 275 on the tenant count population. So my universe equals 275. Now, if I look at months, 275 times 12 months, I can do that. Well, Excel can. That's 3,300 months off. And out of that, I know that 3 out of 25, and this is this is where we run into a little bit of a problem. 3 out of 25 equals what? Well, 3 divided by, oh, let's just do it this way. Man, breaking down here. So that was, 12%. Now, I'm just going to take a real shortcut here. Let's just say that 12% of my tenant calculations were off, an average of $150. If you think about that, okay, you can do this math several different ways. I'm not saying any of them are awesome. I'm just saying when you project out that error, I have to look at the population, my universe total compared to my population. So I could argue that that was a tenant file. We checked them. They were off 25, that was a month or a recertification. They were off. So that was the number of months. So 12% times an average subsidy of saying, if that were whatever, call it $1,000 a person. So I have 3,300 months, $1,000. You can do the math. So that's $3.3 million. That would be a lot of subsidy, and 12% of that would be off. So 3.3, million. And I'm not saying I would do it always this way. I'm just using this as a very quick calculation of that process. That would be a projection. Now, you can project that different ways. That's how you would determine that, Spencer. Somehow you have to project that calculation out. Yeah, it's hard. And in most cases, we don't really get there with tenant files. So I'm going to be honest and say, look, I don't see this very often. It'd be much more like cash disbursements, other sample areas where we would be projecting that kind of error. Anytime you have a sample, though, with errors, you have to project that error from the known to the likely. So the 150 times 3, right, that was the known. And I could have done that by the number of months. So I would have said, well, we know they're off. And I would go then by the annual, so equals that times 12. I am $1,800 off for the year. Well, it's not there. Right? It's not there. But if that is still the number off overall projecting, to the total population, I'm off. I might be over 25,000. And that's why that's very hard in uniform guidance. It's really that way for HUD too, but nobody's asking. I mean, they each put the criteria in to do that. And that's why I said the actual findings themselves aren't that different, but you have other considerations in there. And the biggest one is this projection requirement that is embedded right in uniform guidance. It's not inferred somewhere else. Okay, the rest of that schedule you see gets filled out, and that's why we end up with more problems here in findings than in the HUD audit guide normally. Okay, so so the peer reviewer said, I had it happen to me by my peer reviewer, the 001 versus 01. I tell you, we fought over that too. It's just astounding. It's not the first, so it's not the first time we've heard it. Okay, audit findings, moving on into 518, major program determination. Now here I would tend to rely on a spreadsheet for this conversation. But let's first just walk through this. And let me say this again, extremely important for multifamily housing. You don't need to do it to know the major programs. In fact, that's why it makes it worse. You really don't need this, but you have to fill it out regardless. Even though you pick the right major program, because you've only got one or two that are really easy to see, you've got to fill out this process exactly the way it's described. So step one, identify the type A programs. These are usually always over 750. However, there is, for us, they're usually 750 in multifamily. However, there is a calculation that I didn't embed in the slide that graduates the amount larger based on the bigger numbers of federal awards, okay? So let's just say we start at 750. It goes up from there if you have that kind of size, and there's a table. And all the tool set providers put the table in their guidance. Anything that isn't an A program is a B program, with one exception. There used to be a de minimis requirement. That de minimis requirement is not here anymore. Instead, what you have is a requirement not to look at small programs. So usually we can get below a limit, and that limit is, from my calculations and understanding in the past, it was 187.5. Anything below that really doesn't get risk assessed, and it's a calculation, okay? On how that happens. But at the very least, you end up with A's and B's. And let me just say, you can get smaller B's. You can get small enough that we don't have to consider that program. So it's really 25. It is that. I'm just checking it again. It's 25% of the major pro, or the 750. Okay. So we don't really want to get too small. That the calculation goes into 187.5. So it goes to B programs until you get below 187.5, and then we call you too small to worry about. We're not calling you de minimis anymore. That's a long time ago anyway. Then you identify the A programs that are low risk. Okay? There are no such things as high risk. They're only not low risk A's. And the most recent audit, it had to have been audited as a major program in one of the last two most recent periods. So every third year, an A program must be audited. And it could not have a material weakness or a modified opinion on compliance or any known or question costs greater than 5% of awards. Then you're going to go identify the high-risk Bs. So you'll take the Bs and go into that level. Okay, now, what's easier here is to go, Arthur is mentioning this, non-cash awards. Absolutely, Arthur. Now, I don't see those a ton in multifamily housing, but if you are looking, go back to the determination of awards. And I didn't put this in here because I don't normally see it every day, but non-cash awards can be a big problem for you in other areas that it would come up. So non-cash awards, don't forget that. So you want to go back to the definition of a federal award and make sure you put in there even the non-cash awards. Okay? And there is a section on that, on non-cash awards. I just kind of skipped it for purposes today. Like, I guess RD has some programs, school lunch. Agriculture has, so that's agriculture. HHS has some of these, but non-cash assistance, free rent. Okay, you see a lot of those things going on down there. So thank you for bringing that up. And I just don't see them a lot in multifamily. Then you go to Bs. Now, here's the thing. This is almost better described in a spreadsheet. So I have saved a spreadsheet down there. It's just visual. I'm a visual person. Now, this one has some public housing numbers in it. So please don't be too turned off by that. Oh, no, remove the files. Recover my files. No. Now, we've tried to make this as easy as possible. And how we would do this. So if I'm looking at this, I look the last few years on what happened. And obviously I've got public housing in here. I like to include public housing because there are so many more programs. It makes this thing a little more complicated. And these were the awards. So you can see in this particular case, nobody was an A program. They were all B programs. And I had to then decide which of the B programs was going to be high risk. And I didn't change those years. So 2020. Now, I would have used then my prior audit experience, findings, multiple internal control structures, large pass-throughs, prior audit findings, not recently audited, government oversight, or inherent risk of the program or the program life cycle. I would then, based on that, determine which of these were then selected until I got my percentage of coverage. Okay? Now, I picked one here, and since that was 525 in 2020, I was a low-risk auditee in this particular case. If I was there, I would meet it under both requirements, either high risk or normal auditee, non-high risk or low risk or non-low risk. This is the problem in multifamily housing. If you pick the loan program, you're going to be basically there no matter what. Now, the dollar threshold, I just left here, 3% of awards or $750. In our case, it's $750. The de minimis was $187.5, although we don't call it that. Major program determination, you list here the criteria for risk here, and low risk auditee criteria here. And you should be able to make all this happen. The low risk criteria were here, audited in one of the prior years. No material weaknesses in the most recent, no modified opinion, no question costs greater than 5%. And then the 519 criteria, which is right here, listed here. If you can get through this, even if you only have 2 programs, you need to fill something like this out. Even if you have 1, you need to fill this out. Now, what I would do here on the cluster, the Section 8 is a cluster, so we're about ready to talk about the cluster. Sanchi, there's only one cluster in HUD. It's the Section 8 cluster. Now, when you have a cluster, Now, I brought this out for a particular reason. This was the CFA. This particular CFA is incorrect. Why did I highlight that? Because it is not listing the fact that this is a cluster. In fact, let me just hurry and add the text. I didn't want to do that. That was weird. I'll make it red and bold. Anytime you have Section 8, you have a cluster. You are at least required to identify that it is a cluster. And I think I put that back down on the slides here a ways on the basis for determining awards. On one of those, there should have been a slide or somewhere that mentioned cluster. God, I guess I can't remember it now where I had that. But you do, here's the thing, you need to identify the cluster. And in all Section 8, they all should say cluster. This is about a 50-50 proposition in multifamily housing. Now, for our purposes, the testing isn't really any different or any of those other things because we're just part of that cluster. We're 14,195, and the Section 8 is a cluster. But for where Sanchi, where I see this really the biggest problem is in the CFA, not identifying it as a cluster. Okay. And that remains a fairly significant issue for me to this day. I mean, this is a fairly recent one. So, I don't mean to, to hammer on individuals or anything like that. But when you see this, you will see that it's a 50-50 proposition in multifamily housing. We never identify I don't identify it 50% of the time or more. Okay. Now, if I'm in the peer review checklist, that was just, oh, by the way, the clearinghouse is now going to allow me to reset my password 5 or 6 hours. I did that at 7 o'clock this morning. And now, wouldn't you know, they're willing to let me do it now that my class is over. I'm just curious about the cluster thing here, by the way. So here's the most recent one of these. Arthur has asked me to post these in here for you. Look at what you see right away, right? I can do the first search here. Does the audit results section of the schedule of findings and question costs contain all the required information? And it says identification of major programs. In the case of a cluster, only the cluster name as shown on the schedule is required. Oh, let's look for another one. That's 2. That was the only place I saw it mentioned. So that should be there. I do not see the section 202 prac is not identified as a cluster. That's a formal definition, by the way. So if you're in the compliance supplement, they will define a cluster. That's not something that happens there by happenstance. The 202 prac is a combined program with the prac and the capital advance tied together under one CFDA number. And so we wouldn't show them that there. If I'm in the CFA and I closed it, that was great. Because I can't spell sample. What I would have done here on a 202 is I would see this in here look, just add the darn text. Quit giving me all these boxes. Okay, I would have had the section 202 program, and then I would come down and I would type it in, and then I would go capital advance. And then I would come over and put the dollars, you know, 1, 2, 3, 4, 5, 6, whatever. And then I would come down and I would just input the prac. I'm going to just keep it short here. And I would, you know, put the numbers in here. $65,000 or whatever, right? And I would just have the total going over to that. Now, I don't think there's anything wrong with that. I do list them out separately just because I like to identify the prac and the capital advance separately, but they're both under 202 and not considered formally called a cluster, okay? Save that. Okay. Now, while I'm on the CFA, Roy, let's talk about CARES Act. Now, Roy, you probably can come from public housing and you know we're going to have CFDA numbers for public housing. However, in multifamily housing, if I'm looking at my email from this morning, I don't mind just sharing this out here for you. This is the email that came from the HUD people this morning. And I was trying to have a call with Scott yesterday. And you can look down here, how this I won't send all this stuff out to everybody, but it's saying that we should probably get this CSP money, CARES Act money. The only thing we have for CARES Act money that will be unique is COVID supplemental payments. Oh, and I will share the link for the Q&A for the single audit. Yes, I forgot to just put the save button on that. So CARES Act CFA, what we expect to see is everybody leaving this in 14,195, somewhere down in here they tell us. So they're saying, look, we're going to stick with 14,195. We're not going to go to a CARES Act specific thing. We're going to record any supplemental payments under 5193, the account number for COVID supplemental payments. Any other CARES Act money you will get will have been normal subsidy, and you won't know how much you got. Okay. So they allocated $800 million to regular Section 8, and I've discussed this with HUD. They have no way to identify that money for us. The client has no way to tell if they spent it. We have no way to know. And they're gonna think about that. I keep trying to talk to them, and they're not clear on that. So regular CSP money will go to special claims. It will be under 14,195. Other CARES Act money, PPP loans, if you got the loan at your, they won't be federal awards, okay? I think the AICPA has got that comment back, and other COVID money, I'm not sure where it would come from, so it would depend on source. So there's lots of money flowing around in other sources, but from my main HUD area, we do not expect anything different on the CFA. It'll be part of the Section 8 cluster. It can be separately. I would not even identify it on the CFA as COVID or CARES Act. If you got CARES Act, it might be possible to identify it as CARES Act and separate them on the CFA, although I'm not necessarily sure there's a requirement. So bottom line, Roy, public housing, they're giving out better guidance. It's better defined guidance. Multifamily housing is not got any out. This is supposedly coming out in a housing notice soon. So housing notice in the works. I have not seen the draft. It's in clearance, whatever. That's all we know. There is no other guidance about CARES Act money in the CFA. Now, going into public housing, yes, you've got numbers, and we're identifying those. And they're giving better guidance in their report. They've already issued their reporting item there. Okay. Now, on back to finishing up the slides, and this is going to be important. I do need to finish here because one of the main things I wanted to do is not been covered yet. So, major program determination. Look, low risk oddity covers 20%. The spreadsheet should be able to highlight most of that for us. No problems. Now, document the risk assessment analysis. Please, please, please do not let the fact that you only have one program stop you from filling out that dumb spreadsheet. Use my spreadsheet, fill it out, go through the motions. It's absolutely imperative that you do that. In fact, we may go back to the peer review checklist here in a minute to go through the other items as we finish. Now, federal program risk, how risky the program is. I already put that in the spreadsheet, and so I won't go over that again here. If you use that spreadsheet, Derek, what liability would I put the outstanding PPP loan in for REACT reporting? If it's actually the loan is actually taken out by the project, and here's the next thing, Derek, with the CFDA number. And I'll tell you what, the peer review checklist hasn't been added to that information yet. So hang on, let me put the peer review checklist down there. Michelle, I'm just saving an item down into that attendee folder. It's going to say peer review checklist or whatever. And I'll put the others in later. But if they're looking for the direct link, can you post that direct link while I go through this other material here?
Sure, no problem.
Thank you. Okay, now, I would probably just put it, look, here's the dilemma. Is it a finding to get that, if you got the loan at the project and you had a mortgage, did you violate the regulatory agreement? That's the number one question outstanding now for me. Now, if you got the loan at the project, what's the likelihood that you will not meet the requirements for forgiveness? And it better be damn slim. So, for most of us, right? So what I would do is if I can show that I'm going to meet the criteria, it would not be on my books as a loan. It will be on there as a grant. And I'm stuck with 958605. And I would account for it as a grant. And I would recognize the revenue and be done with it by year end and not have any problems. The only time I would leave it as a loan is if I thought for a minute I might not be able to meet the forgiveness criteria. And I don't want to recognize the revenue for a couple of reasons. Namely, that would be the one. And I would leave it as a loan. And if that's the case, you're going to take, you potentially take a hit by having a non-compliance on whether or not you should have gotten the PPP loan without HUD approval. Now, if you had HUD approval, it's not a big deal. I would put it in a category, just other notes. I don't remember the line, but don't put it payable from surplus cash, okay? What I'm waiting for at the moment for both Derek and Christopher, you're asking essentially the same question, I think, for that. If I'm a for-profit entity either way, if I can meet the forgiveness requirements, I'm going to recognize revenue, and I'm not going to leave it on as a loan. I want to hit revenue. I want it in equity by the year end, and it's not going to sit there as a loan and cause me a REACT problem. And now for the for-profit side, you can do it with under either IAS 20. Of course, you can leave it as a loan, and you won't get it forgiven until you won't get it released until it's forgiven. So the other option is, and what I'm going to do here, Christopher, is I'll post the AICPA guidance that they describe for us equally well to nonprofit or for-profit, rather than there's some things I need to cover here in the next 5 or 6 minutes. So I'll post that there. If you have a problem, either one of you email me, okay, on the PP loan side thing. There will be, Q&A. That Q&A is done. CFA presentation, I've tried to answer that. Nonprofit nursing home, stimulus funds related to COVID. Is this a contribution? I would think generally it is, but you'd have to let me know. So follow the 958-605 guidance that I'll post in the materials link. It's the AICPA's listing those out, but for a nonprofit, there's only one choice. It's 958-605, or what we would know as ASU there. Christopher, I don't know that they're not looking for any particular account. They don't know what to do with it anyway. So for me, if the loan is outstanding, I would not record it as a loan. I would record it as a contribution, which is what it's ultimately going to be, unless there's a fear of not forgiving it. So if you want to discuss it with me, email that to me, or give me a call, or we can schedule time for a call. Okay, after this is over. So nonprofit, anonymous nonprofit nursing home, same thing for you, 958-605. Now, last but not least, I need to really do this. I think we've gone through most of these questions. I need to get to part 7, slide 55. What happens when you're in a program not covered by the supplement? That is most of the HUD insured mortgages, by the way. So when you're not covered by a supplement, you are to then identify the types of compliance requirements by identifying those things and looking at the supplement, which is number 7, part 7. Part 7 then says you've got to allocate this to the 12 types of compliance requirements. And you've got to look at this. And then what are you going to do? Let me go backwards. Oh, sorry. I need to go forward. Sorry. When you identify the compliance requirements, you have to tie those compliance requirements into the 12 types of compliance requirements of uniform guidance. Now, next step, discuss it with the client. Review the laws, regulations, the HAP contract, the reg agreement. Of course, HAP contracts, you always have a supplement. But the reg agreement is not. You review the CFDA, okay, it's 14-155, and then you're told to look at the OIG programs if there is a guide. Now, here's where the HUD audit guide comes in. Chapter 3 of the HUD audit guide. If you are in an insured mortgage, you are to go through part 7 of uniform guidance and link to the HUD audit guide. And then what you're going to do, lo and behold, I've already thought of you. We have for you a spreadsheet that is called the compliance matrix. So you write a little memo, you reference part 7, you've done those other things, and then you go to the HUD audit guide, and we've listed each one of the HUD audit guide procedures and correlated it to the 12 types of compliance. Oh, why is that not listed there? So I've got several versions of sitting around here because I made changes. That's the uniform guidance link that you need to utilize to link the HUD audit guide to part 7. This is absolutely imperative. Okay? If you have an insured mortgage, there is no supplement. Part 7 is your jam. You write a quick memo. You reference the HUD audit guide. HUD's already told you they want you to use it in the guide, and we've taken the HUD audit guide and correlated it back to the programs and the 12 types of compliance requirements. So therefore, you can go right to the HUD audit guide, pick the things you need to test out of that, correlate it back. It's correlated back for you already. You just need a short memo because there is no supplement. You referenced part 7. And this is going to become much more important as people get nonprofits are going more and more and more to insured mortgages. They allow distributions in general. They don't have residual receipt requirements. I mean, all the things are getting better from HUD's perspective. Now, last, because we're running out of our time. And yes, there will be a recording of this available. This checklist, does the documentation include the following? Management defined the entity. Okay, we talked about that. Establish an understanding. Yeah, the engagement letter will do that. Follow up on prior audit findings. Assess the reasonableness of it. Okay, there you accepting responsibility. Materiality. Designing tests in accordance with the supplement. Now, especially when you don't have a supplement. Audit risk over compliance. Okay, audit risk over compliance is basis for planning the audit. Yep. The report on internal control. Evaluate the likely question. Oh, see, there you go. The likely question costs, not just the known question costs. Man, I'm going to highlight this baby and then resave it. So thank you, Arthur, for sharing this. You would, you know, if this doesn't show you, we just went right down these requirements. Materiality in relation to the type of compliance requirement for each major program for purposes of finding. So you had to determine materiality at another level for findings. The reports, I assume if you're doing the reports correctly, your reports, if you're following that, they should be good. Okay. Schedule of findings and question costs. I'm sure we went over every one of those things that are listed here. Only the cluster name again. Looks like we've got most of it caught up. Please, please, please do not take these things lightly. Single audit is a huge risk. And peer review is going to be looking at it more and more and more. Okay, questions. The compliance spreadsheet is out there for you already. And Arthur's, the peer reviewer, saying, look, and I agree with this completely. Take that peer review checklist and use it as part of your monitoring process. If you're going to do a little EQCR or something like that, or at the end of the year, just to make sure that you do that. Use that checklist for that. That's absolutely an appropriate use of it. So the spreadsheet is already there. We have for-profit projects that have 202 loans. Okay, and I'll put the PRP checklist, the other PRP checklist out there. You have a 202 loan. If you are a 202, you have now graduated into something else. Okay, so you're a for-profit that took on a 202. There is additional guidance for that. You don't have a single audit, and I would use the same spreadsheet that I used, so I would assume that is absolutely correct. Would using the guidance for a Section 202 on a 223 loan be acceptable? No. 202 loans have a compliance supplement, even if they're direct loans. You still use the same supplement because they're tied to age restrictions. If you went to a 223F loan on a refi, then what I'm going to do is I'm going to use the HUD audit guide, but reference the eligibility criteria that go along with that in a use agreement for the senior housing and add it as an additional compliance element, but you are a 223F in the CFA. Okay. Okay, I would not use the guides for 202 for section 223. That's good. I've answered that. If you have a for-profit that went to a 202, I would, yeah, you're gonna use the supplement. You're gonna use the HUD audit guide, and we leave that there. If you look at the compliance supplement, the compliance matrix, we tie that in over here to 202, even though it might not be a capital advance. So you have that in there. Okay, answer live. I'm just down to answering the questions. During the tenant file testing in the current year for recertification, they were not completed due to COVID. Are those considered findings? Absolutely. Okay, Loretta, let me tell you how that works. When we covered that in our update class. I didn't really get into COVID today, but the occupancy guide requires that those procedures continue, even if they're under extenuating circumstances. They continue. And that means the client may have, the tenant may have self-certified income, all those other things, but they still had to do tenant file testing. Okay. And if they didn't do any, that's a problem. Okay. I'm just telling you, there were no gimmies on tenant file testing, no excuses to not do it. In fact, by now they had timing issues. They could have taken more time, but by now they should be mostly caught up, and HUD is not granting waivers for recertifications. If you need that, I have the Q&A for that. Email me. Email me the specific Q&A. Okay, now, do you still test Section 8 if it is non-major? No, you do not in a single audit. If it's above the what I would call the de minimis limit, the small limit, it would get audited as a B program. That means over 187.5. It would get audited as a B program once every 3 years. In those off years, you would not touch it. Okay, Jamie? So if it's non-major in the spreadsheet for-profit, there are still some yellow book requirements, but it would not have to be tested anywhere near the same, no sampling, none of that stuff, okay? Somebody's put my name in there, but they didn't put a question. If the audit team audits the statements of a Section 811 loan entity and prepares the financial statements, what safeguards do you recommend to remain independent? Okay, now look, I didn't mean to get into this today for single audit because it's really not a yellow book problem, but it's a legit question. I will put into there a list of safeguards. I will put into the single audit area our list of safeguards, and let me just discuss it really quick. Oh, good grief. Where did the update go? Safeguards. Good hell, Les. Okay. We have a safeguard list in Excel, and I will save it down to this material for today. This is the list of safeguards, and I have a better one I'll put down there. You have a list of, this is the AICPA's list of Code of Professional Ethics safeguards. The one safeguard that you probably need to have is just the involvement of another professional P, an additional reviewer. Now, look, you should engage, you should take credit for all, the safeguards in yellow here are the safeguards I think every firm has. And so to me, to focus on one safeguard or another is kind of irrelevant, but the question of one special safeguard is the independent review. So I'll save a different safeguard list down there. Michelle will help me here to get all this taken care of. I will put the question on the 605 down there. Arthur, yeah, I do. I think sole practitioners have a unique problem with safeguards if the peer reviewer is stuck on only one safeguard, and that being independent review. Now, I don't really believe that should be the only litmus test because there are a lot of other safeguards, but a lot of peer reviewers are sticking to only one thing they care about is whether you have an independent review. That is probably a discussion for a little different thing. So, Chris, I'll put the safeguard list down there, and I will share the 958. So Arthur's talking about utilizing outside CPAs on client staff. Yeah, it's hard. I've even done it for a couple of people. I've done independent review, not as a thing, but just as an industry expert. But I think that takes care of most of our questions. We're beyond our time. I knew it would be tough, and I know people want to leave. I'm sure people have. Michelle, what do we have to say at the end here, Michelle?
Thank you for your participation.
She can't. She's going, I need to cut this off.
No. If you attended in a group, please send a copy of your group attendance tracking sheet as soon as you can to Kathy at ahacpa.org, and CPE certificates will be emailed to you within a week.
Anything else, we'll try to get over there in the next few minutes or half hour. And you can always look, Les at ahacpa.org. You know how to find me. We can answer your questions.